From the heart of Africa's entrepreneurial frontier, Foundersbattlefield uncovers the raw journeys of bold visionaries. In episode 3, The Finance Mafia, Inside the Capital Club, join host Michael Anthony Macharia and resilient founders Christine Oseko, Edwin Dande, and Bobby Gadia. Through Christine's legal insights on legal aspects of fundraising and financing deals, Edwin's battles for fair access, and Bobby's rise after setbacks, they share life lessons on navigating capital's challenges. Learn how to protect your vision and thrive in Africa's dynamic landscape. Share with friends and colleagues on your social media channels. Happy watching, and let Foundersbattlefield light your founder's journey.
Welcome back to Foundersbattlefield. Today I have great guests, and we're on episode 3. It has been an interesting journey for the second episode, and also just getting to this journey to where we have reached. Today we have a very interesting topic, which I think the topic is a bit controversial, but it's not meant to irritate, but rather just address the whole issue about capital. We call it the Finance Mafia inside the Capital Club. So we know raising capital significantly is one of the most important items for some of the founders. And their stories around raising money for their business or working capital is an area we want to debunk and also bring some level of clarity, but also share some of our experiences. This is really where we are trying to discuss where informal power and formal finance collide in African markets. We know how capital is structured in whether it is private equity or financial structures through banks, or even angel investors, but also informally when you go to friends and family, how you raise capital to start a venture. But what are the dynamics around capital? Do they fund a business? Do they fund the founder? And how do you align interest between people who provide capital and the people with great ideas that require capital? That is going to be part of our conversation today. And with me today are some people I know for very many years. Interesting enough, we call them the men and women in the arena who have chosen to share their stories. But in order to do that, they're also inspiring the next generation of entrepreneurs and founders, even current founders, who may be going through a whole financial transaction today, but require that level of clarity of thought to be able to make the right decision moving forward, or even just make a decision. Because sometimes you don't make a decision because you don't have the information, or you need somebody to validate what you're trying to do. So with me today is somebody I've known for 28 years, believe it or not. I met them when I was 22, 23 years. My first job, I'd gone to sell them something when I was an accountant with my first employer. And this is Bobby Gadia. Bobby, great to have you.
Thank you.
And great to see you. I know we've been meeting many times, but today is going to be interesting because finally we sit and really have a conversation. So great to have you, Bobby.
Thank you. It's great to be here.
Okay.
And it's just amazing to see how 30 years have flown.
Yes.
Just the other day, we were sitting and buying and selling computers.
Uh-huh.
And now we're going to talk about the 30 years that have just made us a little bit more wise, I hope.
This is great. And then with me, thanks, Bobby. I'm really looking forward. I know we've talked for a long time trying to share our stories, but I guess finally we're here. And then also a good friend of mine called Edwin Dande. Edwin, I've known also in my corporate life, and we connected when we came back from overseas, and he came back to Kenya. So Edwin, great to have you.
Asante sana. Glad to be here. Looking forward to telling stories.
So Edwin will definitely be a great contributor, both as an investor, but also on the other hand as an entrepreneur in the real estate and other industries that he's in. And somebody else that I think that is a very good friend of mine is Christine. Christine Oseko is a lawyer, and I think she's high. We spent a few times together talking about the whole value chain around raising capital and the legal structures around raising capital and what it comes with. So really looking forward to have Christine and for you to share stories around your whole experience around legal entrepreneurship, and also you as a founder of your own law firm and as a managing partner, your experience around that. So
Thank you, Macharia. Looking forward.
thank you. So I know we always start this way, and before it gets hot, the question is, the first thing we do is try and create a frame around the conversation around capital. And when we look at capital, can you do without it? Do you need it? Yes, you need it. Are there moments when you raise capital and you don't need? Sometimes. Are there points when you need capital and you don't get it when you've got a great idea? Yes. Are there moments your capital partner pulls the rug from you and it's raining, they don't give you the umbrella when you really need it? Yes, those things happen. So we wanted to delve into how the whole ecosystem works around capital. Now, starting with the story, and I'm going to talk about my whole life around capital. I started my business 25 years ago. I was maybe 25 then. And my first raise in terms of capital, I would say was customer capital. You know, when customers give you an advance payment, it's almost like financing your business, if you think about it. Yeah. And I think if it wasn't for the first customer giving me what we call almost 70% upfront payment to deliver a service, I would maybe not have raised that money. I would maybe never have started the business in the first place. So in one way, when you think about customers also being your financiers, it also creates a conversation. And if you think today, if you look at the conversation around entrepreneurs who have significant pending bills, you think about you have no choice but to go back and raise capital because of the pending bills, because your working capital is disrupted, right? Now, so when I look at my story, when we started, I remember for me, as a business, which was 76 Technologies then, I met a great partner who really invested in me as an individual, right, as a founder. So it wasn't, I don't think my business was very profound in terms of what I was doing. I was buying and selling. You can imagine, I was trying to buy and selling technologies, nothing really dramatic. I'm not manufacturing IP. I'm not doing anything. I'm just really a supply chain vehicle, right? 1-2 employees, 1-2 engineers. But when I think about my first venture angel investor, the late James Gashui, I think some of you know him from Monainchi Online and Transcentury then, we just became good friends, and not even good friends. As a matter of fact, that was, I think, a bonus that we are friends. I think what happens, he looked at me from a point of view of potential. So really, what it boils down to, the first set of capital that you get is from people who believe in you as individuals. So really, what are you backing? Are you backing the individual? Are you backing the business? That's not something we need to talk about. And sometimes, if you think about it, in Africa, 15 years is really when we start backing the business and not the entrepreneur. So backing the entrepreneur becomes so important that even when we raised private equity from Orios, it again, the main angel investor who was backing me, who then convinced the private equity company to also back me, but then the numbers were adding up at that particular moment. But moving on, when we finally even raised additional capital from private placement, brought individuals on the table, told them, look, guys, I'm going to list the business. I'm going to be in the stock market. The numbers are looking great. We even started having conversations with the Nairobi Stock Exchange to be listed by introduction. Those investors who came individuals and said, look, I'm going to put part of my capital, my own hard-earned capital behind this business, is because they knew they were going to the next the next phase, which was, let's go to the stock market. There's a position of exiting, okay? And then the next phase of investors that came in was, again, corporate investors. We had people like Toyota Corporation. And when I think about even Toyota investing in my business, it was really a very interesting journey, because when they came to invest in our business, then 7Cs as a business, I didn't really even know it was Toyota. They came through a third party who had been looking for investment assets in Kenya. And they came to us, eventually Toyota came to us as an investor. I was surprised because it was almost like the last mile. They said, oh, by the way, it's Toyota who is investing. The Japanese fund investing is Toyota. And I remember jumping. There was so much. It took so long. The lawyer in the transaction, Christine, not Christine then, but somebody else, they were taking so long. Let's do checks. Let's do checks. Let's do these checks. Let's do these checks. It was getting to a point where I was not even getting to a point where I said, don't even need this capital. And I remember making a decision to take a flight to Japan, right? To Tokyo. And I just said one evening, this capital, what's happening? It's not coming through. We're never closing this transaction. I just jumped into a plane. It was not something I had planned. I told them I'll be there on Tuesday. I jumped into a plane, got to Tokyo. It was my first time in Japan. Met the executives in Toyota. And I remember the top executives really connected from a point of view of, we need to do this. We need to create this transformational vehicle for Africa. Then we were doing a lot of healthcare transformation projects. And they believed in me as an individual. I remember having dinner with the deputy CEO of Toyota. Great dinner. And we really talked about, not even about my business. It was about my view of Africa and how we can transform Africa as entrepreneurs. And I think when I came back, I wrote an email to him, thanking him for the trip and the kind of hospitality that they gave me. And I said, look, I would like to complete the transaction. No, I didn't even say about complete it. I mentioned that I think it's time we move forward with our discussions. And I just said, look, I appreciate how we engaged our big idea about Africa, transforming Africa with African entrepreneurs. And then I closed the conversation. And trust me, 3 days later, they wired the money to close the transaction. This is something I've been trying to close for some time with all these middlemen in the middle trying to finalize, legal people trying to put condition precedent, all that stuff you guys put in legal. But then they said, look, we trust Michael. Let's proceed with the transaction. Subsequently, as you can imagine, many things happened in the middle. Got into a big government project that went haywire. That messed our stock market capability. Today would be maybe one of the large companies in the stock market. And then at some point, even before that, there was also a potential exit position. We were going to not exit, but have a strategic investor, then was Safaricom. And at some point, we had done so much with Safaricom in terms of them becoming an investor in our business, because we were one of the largest local indigenous companies doing work for Safaricom. That project also, as Michael Joseph left the CEOship, that project also went into the garbage bin. So you can imagine you've been in this journey, either trying to exit into a corporate multinational. Today would be maybe one of the largest technology companies in this market, as you can imagine. Number two, we'd be listed as a private company. Then it takes somebody in a political position to then destroy those plans because of their own vested interest or whatever it was. Today would be probably one of the listed companies in this market. So when I look at the stock market and look at the growth, and the only technology company is being Safaricom today, it's really a pity if you think about it, that today we should be having a lot of more transactions in the stock market. So that's another market that you can raise capital. But then moving into that, started a new business, which was Ponea Health, looked for partners, a partner who we knew each other from our associations in YPO, Young Presidents Organization, raised capital from individuals, maybe 30, 40 individuals during COVID. I must admit, these are angel investors. We raised to build this Ponea business. And I must tell you that out of 30 or 40 investors, who 90% are non-Kenyan, are global investors, 90%. I have never, out of those 40 investors or so, I've maybe only had coffee, tea, lunch with three, 1 to 3. We've never met, we've never had lunch, we've never had coffee. It was just, what is your idea? What do we need to do? How do we support you? So it's been a very interesting journey, at least for me, and building this, and also then asking myself in future, what is there? How do you raise? What lessons have I learned? So part of this is just opening up and trying to explore some of what it took to build that journey as we go along. So I'd like to, with that conversation and starting point, or maybe introduce Edwin. And because Edwin is acting both from an investor point of view and also as a founder, maybe share your story. Then what we'll do, we'll try and then understand from your story and Bobby's stories and Christine's experiences. We can then sit down and sort of further interrogate what this whole capital structure means. Okay? And for me, I think my takeaway is people invest in me as an individual and not necessarily the business. That's my biggest takeaway across the journey. So, and the biggest challenge moving forward is how do I make sure that they still invest in me in the future based on the commitments that I made? Edwin.
Thanks a lot, Mike. I'm trying to figure out where to start and end up in capital. And I think I'll give just a brief background. And the background is less about me, it's more about context. I was lucky to leave here after high school and went to school abroad and then ended up in Wall Street. Now, Wall Street is about finance and capital as it could ever be in this world. And one thing I realized, when we talk about capital, we think about money, but really at the center is about making the world a better place to live. Now, if you have to make the world a better place to live, that means you have to have better services, better products. And when we talk about better services, better products, almost everybody in this room probably has experienced Apple, has experienced Google, YouTube. And if you look back at where Facebook, if you look back at where those things started, it was always an idea, an individual, and capital. So while it's about capital, really what we are talking about here is how do you make the world a better place to live? And if you look at advancement, it started with rail, road, cars, planes, and now we're in the digital age where it's about YouTube, Apple, Gmail. If you look at that transition, it's always an idea of how to make the world a better place, an individual and a team that believe in that idea, and then they want capital. Now, if you look at where people want to migrate to, today, if you just ask a Kenyan who wants to make their life better, they most likely want to move to a Western country. Why is it that they want to move to a Western country? People are always complaining about, oh, I want a visa to go to the US and I can't get a visa. If you ask this individual, why do you want to go? They just believe that it's a better promise. Now, if you then take a step back and ask yourself, but what is this promise of America? I don't think it's much more than really two things: free people and free markets. I won't talk much about free people because that's for politicians, but essentially it is a proxy for democracy, people having a say on how they will live. But let's go back to free markets, which has to do, which is closer to the topic of today, which is capital. It is really a place where an individual with an idea can go before a market, before a committee, before another individual and say, here's my idea. And this is how this idea will produce a better product or a better service for the world. But what I lack is the money to buy a laptop, the money to get a desk, the money to get a team, and to start putting this product together. We talk a lot about Elon Musk and the things he does. Why couldn't he do them in South Africa? He had to go to a market whereby I can put my idea on the table, I can sell it, I can get money, and then be able to fund the realization of that idea. So for me, I always saw people in Wall Street come with ideas. They go before an investment committee, and I sat in those investment committee meetings, and the idea is vetted. Will this make the world a better place? Because if it's going to make the world a better place, that means the product can be sold, and if the product is then sold, we will get our money and make profits. Because don't make any mistake that the owner of capital is into it for any other thing other than their return. And they will not make their return unless the product or service is going to be sold. So after several years on Wall Street, I looked at myself as just one of the thousands of investment bankers. Yes, we are having an impact to the client, but Wall Street did not need another banker. So I thought maybe if I come back home, and I'd never worked in Kenya, I would have an impact. So I came back, worked with some firms, and as I was looking at returns by asset class essentially meaning the type of investment, I looked at returns in fixed income, I looked at returns in equities, and I realized the returns in real estate were really, really attractive. But when you looked at the real estate that people were bringing to the market, essentially it was just basic shelter. A roof over your head, it's a place for you to go sleep after work, but there's no comprehensive lifestyle, there are no comprehensive amenities. So we modeled and realized that if you can deliver real estate with a comprehensive lifestyle, a place with a swimming pool, a place with a daycare center, a convenience store, elevated play areas, people are willing to pay. There are markets where, especially markets close to the embassies, Gigiri, UN, people are willing to pay for that kind of thing. But the problem was capital. So we asked ourselves, if you can come up with a vehicle for capital, because in most cases when people want to put up real estate, they'll go to the bank. We asked ourselves, if you came up with a product, because where does the bank get money? It's from you and I. They give you 0%, then they lend it to a developer. And a developer will pay anywhere between 18 to 20% to access that money. So we asked ourselves, if you are able to go to the individual and say, instead of giving this money to the bank for 0%, then they lend it to me for 18 to 20%. Why don't you just give it to me? And then I'll give you the 16% high yield return, so to speak. And we found there's quite a bit of uptake. So that was my experience now with going directly to the market to access capital, not as Edwin, but as a team. And when we get that capital, what do we put it in? We put it into investment grade, aspirational, comprehensive lifestyle real estate development. Of course, that comes with its challenges. When you just decide you want your capital back, and like a bank where you can go and say, okay, give me more time to pay. An individual will say, I want it and I want it now. And if you don't give it to me, I'm going to go to social media. So capital also has its challenges. But the point I'm trying to make is that it's not about money, it's not about return, it's about how an individual can produce a product or a service to make the world a better place to live. So for me, the challenge and why I'm attracted to this effort that Mike and team are doing, I think we need to find a way to make Kenya a place where people with ideas, regardless of where they come from, we just evaluate the merit or demerit of that idea. How can these people access capital? And if they access capital and produce better products, better services, a rising tide lifts all boats. We are stuck in an environment where you come from, who backs you is so important. And I think that reflects in why we are an emerging market or a less developing country, because we still want to look at who is bringing the idea instead of what is the idea. If this initiative can at least get to a point where anybody with an idea will bring it on the table. Once they bring it on the table, we evaluate it. If it is going to lead to a better product or a better service, then we back it. Ultimately, the consumer makes the decision. If they buy, then that particular idea will flourish. If they don't buy, because capital is also not entitled to return. There are cases where capital will back an idea, the consumer will say this is a bad idea. As long as bad ideas are killed quickly, that's also part of capitalism. Let good ideas flourish, let bad ideas be killed, and let the owner of capital realize, I backed a bad idea, it did not work. That doesn't mean the entrepreneur is a crook, doesn't mean they're a bad guy, it just didn't work. Part of delivering good products and services in the market is trying products, and some that are not good will die. I don't know if you guys remember, there used to be a product called BlackBerry. Now you can barely see anybody with BlackBerry. It had its time, it died. It doesn't mean that the owners of BlackBerry were bad people. The idea just died. So the second thing, in addition to advancing this idea that let people bring their ideas and let's back them based on the merits of the idea, the second aspect is to make it normal that some ideas will die, and that doesn't mean those are bad people. We have a market that's very unforgiving to entrepreneurs. I don't know, today I don't know where the owners or founders of Nakumat, for example, are, but Nakumat was a great idea. For some reason, it did not work. We need to have an environment whereby people who back an idea that doesn't work will have a second chance, because you don't have to succeed on your first try. Maybe it's the third try. It is good for the economy. It's good for our market that entrepreneurs try over and over again until we break through. That's what will move us from where we are today to a middle income, growing economy with a lot of jobs for people who want jobs. So those are the two ideas I would want to put on the table.
Great. And I think we're going to build on that because, Edwin, that's a great point, because we have to ask ourselves, are you going to be a nation of builders? Are we going to be a nation of transactional buyers? Because if you're a nation of builders, we'll encourage entrepreneurship. If we're a nation that we want to be transactional, we will be going and buying products or ideas from other people globally who are backed by, who are founders, who build those businesses. But then we go and go to all these other countries, do site visits to say, I'm going to get the same idea that was done by an entrepreneur who was given an opportunity in that market and now exporting the idea back here. And I feel we are also in a certain moment right now in our realm, especially we are all hitting 50s, I think us as Bobby and Edwin, where we are beginning to realize that the country is becoming very transactional. The question is, are we going to be a nation of builders, right? What do we need to do to get Kenya to become a nation of builders and not transactional people? And I think that then swings the question to Bobby, and maybe having, not even a question, getting Bobby onto the platform and the stage, for him just to share his journey. I think your journey has also been very interesting. Very young as an entrepreneur from age 23, 24, gone through ups and downs. At some points, there's a lot of disillusionment. I think it's great to have your journey in relation to capital and how that journey has shaped your thought process and how today you're giving that advice back to some of the entrepreneurs that you're mentoring.
Absolutely. I mean, what you both have said is very deep, very profound. And when I look at what you're discussing of making the world a better place is really the way forward, right? Well, let me explain my journey if I take it a step back. When I was 22, I was thinking of making my world a better place, right? I want to start a business. I'm sure that I can't do employment. And I've got that moment where I know that employment is just not going to work for me. So the only thing I have left now is that I have to start doing something other than working for someone. So you leave a good paying job as an IT manager at the age of 21, you come back home from studying abroad and you're in a typical Indian household family and you tell your parents that you're quitting the job after having been educated, all the pain they've gone through. And they're like, what do you mean you're quitting? You know, you have to give it a chance. I probably sound like the Gen Zs of that time. And I was like, no, I just cannot work. And I made up my mind and I quit the job and I would sit in my room wondering, what is it I'm going to do? At 8 o'clock, I'd be ready, wearing a tie and sitting on my sofa in my room. So like this, I got into selling computers from my house. And this happened by me meeting somebody, a friend, who him and I connected very well. This guy had the money and me had the skill of selling. And him equally, he doesn't want to be falling under the norms of a formal job. Very well-to-do guy. And he also wants to prove to his family, hey, I'm for business, I'm not doing this job. So both of us connected and that became my first source of capital. I had this co-founder, as I called him, and we started selling I started selling computers from my room. He would import them, I would sell them. And at that time, 30 years ago, the margins were great, you know. And we made a lot of money. And an opportunity came by that we're getting this shop in Yaya Center. And I told my friend, my partner, let's call him my business partner, that, hey, why don't we take this shop and run this business formally? So he says, fine. So we end up, my savings, which I had made, we used that in the acquisition of the shop. and he was funding the working capital to a certain extent. And I remember when we were opening PC World, it got registered on 1st August 1995. We opened doors on 1st September 1995. And naively, we started doing trading. And then we realized, oh, okay, we have money. There's cash after selling products. You have to bank this somewhere, some point, you know. So I was made aware that you need to open a bank account. And so I'm at the bank standing there. And then I filled the forms and I'd done the paperwork with my partner and brought everything. And then she says, we need money to open the bank account, opening balance. So I had, I think, 2,000 shillings in my pocket. And that was how PC World started, a bank account with 2,000 shillings. And PC World was born. Now, we had limited working capital. The next source of capital I got, okay, was supplier relationships. By now, when we had opened this store, we had already been in the market for 1 year informally. Now we're now in the market formally. So the 1 year we had built goodwill. So the suppliers started having some sort of confidence in us. So my first sort of, your funding was a customer giving you 70% of your capital. My funding was going to these suppliers and getting goods on credit.
Okay.
That became my first source of capital. So I went and negotiated 30 days, 60 days, 90 days credit with people. What they loved and what my principle was at that time was, if I'm getting 60 days credit, I need to pay this guy before the 60 days. Don't wait for the 60th day. Go and pay him in 45. Go and pay him in 30, right? And that built the goodwill. And based on that, I started getting more credit. We started getting more stock in the stores and things started picking up. But there's only a certain amount you'll ever get to doing that organic growth. But the point here was, when you asked that question, you know, are people banking on your business or are they banking on you? From my experience, they were banking on me. They were banking on us. So when I started PC World, I was 20% shareholder. My partner was 80%. Within a year, I'd bought him out. And we had already found our ways. But I'd bought him out organically from the business, right? So I didn't need working capital for that. And I needed another partner in the business. And my fiancé ended up becoming my co-founders. So we went 50-50. That's another story about how doing business with your wife can be. We can talk about on another episode. You will need a full...
There's some episodes like that coming up.
That one, you'll need a lot of time for that. So now we became partners and PC World started growing. But how much can you grow with goodwill in the market? Right? There's a limit. So the next source of funding started coming through banks. I never went out there looking for capital from external sources. One, because I didn't know how to do it. I'm not a finance guy, I'm a sales guy. I didn't know how to do it. I didn't know the implications, and I really didn't want to answer to anyone. So what are the choices here? I didn't want to go to family because, as it is, the family was the same people saying, you're too young, you don't have experience, so we can't bank on you. So, you know, you raise capital for family, friends, and fools, but I was the fool in this. So nobody was lending. So eventually, I ended up borrowing money from the banks. So I raised debt. Can you imagine interest rates at 25 to 30%? I mean, that was what we went in for. But what choice did I have? I didn't have any choice. I either continue growing organically and get irrelevant in a short while. I get investors, which I don't know how to manage because I'm a very dominant character and I need to do things my way. They would have stopped me from growth. Or I go and get bank debt. Now, there is a myth about bank debt, right? Don't borrow, it's dangerous. I agree with all this, but it's dangerous if we're not going to manage it properly, right? So when we started, I remember in 2000, I was voted male business entrepreneur by the Nairobi Rotary Club, and I was going there to get my award, and I had to give a speech. So when I gave a speech, I think I cracked a joke on bankers. And I must have said something along the lines that, hey, we're looking to expand, and if there are any bankers here who can bank on us, it'll be a great thing. And it got the attention of a banker in the group. And he picks me and calls me on the side after the speech and says, hey, young man, I like what you're doing. Come and see me. This is my card. And he gives me his card, and I look at it and say, okay. It was a small bank at that time. You could have easily passed it off. And then I remember I go back and my wife and I are discussing, and I pull that card out. I said, this guy looked serious. Huh? He's invited us to go and borrow some money from him, or at least he said he's going to support us. What does that support look like? I don't know. But as a bank, he's going to ask us for an arm and a leg, and he's going to get my dead grandparents to come and sign a will in their name, so which we don't have anything. So we kind of shrugged it. But later on, we said, what have we got to lose? So we called him. This is the MD, the CEO of this bank, small bank, which ended up being a really big bank later on. And we called him, and he remembered. He said, I was just waiting for your call. I'm glad. Please come to my office. We walk into his office. He stops everyone. He calls his head of control, everyone. He says, sit in this meeting. I'm now 26, 27 years old. And he's telling me, how can I support you? I asked a banker telling you that. I think, okay. So naive sometimes can work in your favor. So we just started asking for things. Oh, we need working capital. This is how we're growing. This is the business. This is it. And he just looked at us. He tells his head of credit, he says, go get those forms, fill this, guys. Go sit in this room. Go fill what you have to. I'm sanctioning a 2 million overdraft. I said, but I don't have anything to give you. He said, don't worry. I'm giving you 2 million. He had the authority to do this. So to your point, the guy banked on us. He looked at this young couple. He looked at the energy they had, the passion they have. And that 2 million facility, by the time I was leaving that bank, was at 60 million, right? Within a very short period of time. That means I had the capital that I needed to grow. Is the same banker, how did it get to 60 million? Because I didn't have that level of security. So I remember things were going so well. And I told my parents, can I borrow the title deed of a house? By the way, nobody should ever do that, but I did. So my parents naively also said, yes, my son is doing well. Now, by now, the family and friends are joining and saying, hey, this guy is doing well. Let's support him. So I went with that title deed, I remember, to this banker. And I'm telling him, I need facilities against this because you've been nice to give me unsecured facilities up to this point. He looks at me. He says, I want you to take this title deed and I never want you to touch it again. Go give it back to your parents. And I said, okay, this guy is now rejecting us. Things are going to get tough here. He says, I want you and your wife to go and look for a house which you're going to buy. And it's about time you move out of your parents' dwelling. I was like, is this guy serious? He's still like... The point was, he ended up funding us our house at interest rates of 28, 30%. And in 3 years, I paid for that house. Not 30 years, 3 years. With the blessing from this banker. So the banker was my partner. But he never questioned me. But he cautioned me. He says, you, my young man, you start from walking, you're trying to skip that sprint phase and jog phase. You're now the jogging phase, you're trying to sprint. This got to stop. And naive, and when you're young, you're growing, you think you know it all. And he was warning us, right? Anyway, to cut a long story short, eventually, the same thing that had helped me, the banks, was eventually what brought me down. That was now... But the question I ask is, in your mind, where was the problem? Was it the bank, right? Or was that problem with the entrepreneur? And when you reflect and you stop and you have that moment when you are alone, at the end of the day, I realized that problem lay with me. The warning signs were there. The signals were coming. But we were just too busy in our own optimism bias, just going for it, thinking that wrong doesn't happen to me, it happens to the guy next door. Everything works out the way I expect it to. And things will be fine. But reality did hit, things did catch up, and eventually the banks foreclosed.
The same house?
Yeah, the
Same
same
house that
house,
helped
the
you
same
buy.
house which I lived, which they gave me for 20 years. I lived, I grew. Now it was time for. I even bought a building, by the way, 3 years later, and in 5 years I even paid that building. But then I used all those to leverage and to get more debt. The problem is, the capital was taken in good intention. The bank gave it with good intention, right? And the bank gave me the umbrella when the sun was shining. I was enjoying it. But when it started raining, they took the umbrella off. I was like, hey, I need the umbrella now, not, They took that umbrella off. So they don't really care about your business. They are in business. They were making money out of me. And me, I was thinking, wow, these guys are good, man. But they were making money out of me. Can you imagine the interest I was paying? I had the capacity to pay for it, right? But when things went wrong, and this was where the other problem comes. The first problem was I was the problem making decisions that led me into the problem. When I realized that and I went to the banks to get rectification, now they became the problem, because by the time they were coming to listen to me, it was getting too late. You cannot tell me that I'm coming with the cure, I'm in hospital, right, past the deadline. Now it's too late. So now they became the problem as well. So my lessons were, you're going to banks, it's good. People say it's expensive, but it's still cheaper than going to sell equity and to answer to other people and then lose your own focus. The banks were good to me. As long as I managed it properly and the intentions were right. The moment I lost focus and that money started going into other things, that was it. That became the downfall. But the problem with the banks, where their part was, they weren't interested in my business until it became too late. Had they been participating with me and keeping me in check realistically, I think that the whole situation would have been different. So now the banks became very aggressive, which they're supposed to, because they've lent you money, they need it back, right? And that's when things get sour. So up to this point, they were good, and then they turned. So I was to blame, but the way they managed it after, now I will blame them. We can play that blame game. So for an entrepreneur that wants to do something, and be confident in how you're raising this capital, whichever way you can raise it. But remember, when something is going to go wrong, and it usually does, right? What is going to happen then? And that's where probably Christine has probably seen a lot of contracts where we saw us entrepreneurs sign blindly. Like me, when I was signing those discharge, what do you call them? The charge documents. And they talked about personal guarantees.
You're not thought about it.
Huh? People telling me don't sign personal guarantee, but I said, what do you mean? I need the money, man. Who's going to give nobody else is giving me this money. I'll sign this document. What's going to happen? You sign a personal guarantee. Oh my God. Now when you're becoming insolvent, personal guarantees, you can be sitting at home and you're even looking at your shoes and TV and you're saying, that thing really does not belong to me at the moment. Those are the fine line that I would be saying, please read those contracts, understand, get guidance. You can save yourself a lot of headache later on. So I used to joke about lawyers, but I value them now. They're there for a purpose. We need to seek their guidance.
It's interesting. You've talked about your bank journey, and I think when I introduced my story, I'm not sure why I didn't talk about the journey of banks across my whole ecosystem. It has been a very interesting journey, right? And as you said, yes, banks are your partners. They help you acquire assets. They help you with working capital. They come through. But also I think what you talked about is, why do the banks insist on personal guarantees? It's back to you as a founder. So you could have 10 partners, but they'll insist you, Bobby, are the one with personal guarantees. Mm-hmm. The other guys, they say, we don't care. Yeah. This is the guy who wants personal guarantee. So in a business of 10 people, you as Bobby are the guy who signed the personal guarantee. Everybody else works. Even the corporates that have invested in you don't even accept any personal guarantee. But then you're left holding the the business yourself and things fall apart. And this is going to be an interesting conversation. And coming back to Christine, because even as we sign all these agreements with venture capital, angel investors, venture capital-led PE funds and financial institutions, I think that whole blurry, the kind of agreements we sign, the whole guys are looking at each other in the face, but behind the scenes, things are not very aligned. These guys are not aligned. You're signing this document, but there's lack of alignment between parties. But that document just means nothing because one person is over optimistic. That guy is saying, let's wait and see. And then when things fall apart, those documents come to play. But because you're so optimistic as a founder, you didn't look at the fine print of whatever you signed, whether it was a drag along clause, whether it was your conditions, whether it is when to exit, whether it's when to get diluted. You had not thought through because you had this positive attitude towards the journey moving ahead. Now, coming back to you, Christine, how do you reconcile this conversation when knowing you're sitting in front of founders, they're about to make a bad decision? You're not on their side. You're on the side of the capital holder, the formal capital structure. Then you're also an entrepreneur on one side. So how do you reconcile the fact that this founder is about to make a mistake? You, as a founder, know it, but as a banker, as a legal person, as an attorney, and as a lawyer, really what can I do? I'm here, I'm paid for my assignment. I would love to understand how you reconcile that and how you've sort of maneuvered or have you ever helped, have you ever been in a situation where you've told guys, I think you guys need to go back and rethink this? I'm told in a divorce court, they tell you go and think about you guys before you choose divorce, go and think about it. Is there a situation you tell guys before you sign this, go think about this thing? Or you just sign and say, let's wait for the divorce?
Yeah, it's a tough one because on one, it's about competing priorities. The founder needs the money; they need it now. It depends on whom they're getting that money from. It's a power play, whether they have the power to negotiate good clauses. So, like, for example, Bobby is talking about the banks. So you get your facility agreements and the bank is, we're going to support you. You as the lawyer, I'm going to advise Bobby. You look at the clauses, but Bobby doesn't have much power with regards to whether he can amend that clause or not. Because our local banks, when they give you facility agreements, letter of offers, there are templates which cannot be varied. You can't say, change this clause, change this, change that. Take it as it is if you want the money. So then Bobby is then in a position, I need the money. So what he does, he says, I'm going to take the money. You can advise, he's aware, but he has no choice. So if he's an optimist, he'll maybe survive long enough until things go south, and then I guess he's stuck, So the bank changes in terms of is supportive 1 minute. If things go south, the bank is your enemy the next minute. So how do you reconcile? You have to weigh the risk and decide whether you're going to bite the bullet when the time to bite the bullet comes with regards to debt financing. So the investor has to the founder has to make a decision whether they're willing to take that risk. And with regards to legal advice, the best you can do is mitigate against that risk to the best that you can. But really, it's a founder decision. What's their risk appetite?
Also, just to add, we're aware of the risk, but entrepreneurs they are entrepreneurs because they are risk takers, right? So the appetite, like my appetite for risk was just too much. When it works in your favor, it works big. When you lose as well. But at the time, you never want to think negative about your situation. And I learned something that now in hindsight I would be doing. It's called a pre-mortem. Meaning that if I want to do something today, I'm sitting with a group of people and saying, let's analyze this situation, why it failed. But we haven't started this project, but let's now, this is a pre-mortem, not a post-mortem. Let's sit and think, why has this situation failed? What did we do wrong? What did we not see? And a lot of it is we were too stuck in optimism bias. When we start something, we are just so optimistic that we don't want to think about anything else, and we are too emotionally invested in that idea, right? So if we sit objectively, like now with the experience, me telling my younger self, hey, listen, do the pre-mortem. That I've got the money now, but I failed. What made me fail? And when I fail, what was that failure looking like? When those banks are coming, or those your investors are coming, and the stress you are going through, and how is it impacting you, and how is it? Then I think that my decision making today is much more clear. My risk appetite now has been tamed a little through experience, but also through that experience has become my wisdom, right? But is it necessary for that this new generation of founders to go through what we've gone through, that pain? I think, and this is the initiative that why I'm sitting here, is entrepreneurs are supposed to be wealth creators, but we become wealth destructors. Can you imagine you raise capital successfully, $10 million, $100 million, and then you close or you shut? Like we have these cases in right now that are happening where people have successfully raised money and they've gone bust. I know so many because I'm in that space. Did we create wealth? We destroyed it. Did I create wealth over time? I destroyed it. Right? Because of this risk that we are taking and this optimism that we have blinkers on us that it is going to work out. But the realities could be something different. Right? So we really have to challenge ourselves and say, hey, listen, while we're trying to create wealth, we may actually be destroying it, and we better be thinking about it. And for this people who watch these episodes or this broadcast, right, the podcast, this is the kind of information we want to say, avoid these pitfalls because you're not exempt to them. Learn from us, right? And make new mistakes, your own mistakes, but at least not to this extent. So don't become a wealth destroyer. We want you to become a wealth accumulator, right? And hopefully this is the knowledge we're going to share here.
But I guess, and I think that brings us to a very interesting conversation, and I'll still go back to Christine at some point. So Christine, be thinking about it. You're right. As a day, in this episode, you're also a founder. So I'd also be very curious how you financed your business as a managing partner of a good law firm. But as you think about that, I think raising capital is highly celebrated in this market. Who raised, who never did, how much they raised, that's not a problem. I think we don't even have to move into raising capital and what happened and the success is raising capital. I think we need to talk about when things don't go right, what happens. I think all of us have been there. When things don't go right, I think those are the hard conversations. And this show is about confronting the brutal realities when things don't go right. When you raised and you said you destroyed value, some people may say you destroyed, some people may say they were set up to be destroyed. I don't know, whatever. There are people who are gatekeepers, they realize you're scaling too far, you're going to become a problem to them, and then they start destroying the same. So some people may even invest with you with the intention of destroying you, okay? I think now we probably can move towards a discussion around really when things don't go right. I think that's where this is not discussed a lot. We don't discuss it in boardrooms. Sorry, we don't discuss it in open forums. We discuss it in boardrooms. Things get messy. And for me, when I look at where things didn't go right, for me in the case, I think I had a very good ride, to be honest. Raised capital, angel investment, brought in private equity, almost got acquired, part acquired by one of the largest telcos. That never went, but continued the journey, pivoted into healthcare, got into conglomerate, invest in my business. I was the first, I think, African business that a Japanese company like Toyota invested in. You can imagine the amount of due diligence, trust, and everything else. Subsequently, they invested in other companies that have gone bust. So I'm not even sure how they're thinking about Africa anymore. from that point of investment. And then as you go that journey, you've also raised money from banks. And I can tell you when things go wrong, they go wrong. In your case, and as I hand it over to Edwin, in my case also same thing. Banks helped me grow significantly, whether from instruments that we could create. There are banks that had their seasons of growth. And I think if we started our business in 2000, between 2000 and 2013, there are certain banks that became very aggressive because there was a regime of growth, of building. I think between 2003, if Bobby, you can remember, 2012, I'm not sure when Edwin you came back, there was a high energy in the country for growth. We were trying to build a country from a regime that had been very destructive. So the banks also had taken that same attitude and ethos that we're gonna work with entrepreneurs to build. So big projects came up, roads came up, projects, technology companies came up, companies, people who are doing supply chain. There were very new age businesses that came up then. And even if you think about some banks that started as building societies that scaled in that time, and they backed businesses like us. Most of us banked with those banks, right? And then there's a time when there's a change happened, and banks started taking more of a shy approach in terms of funding. And I think that also speaks to the governance of the political environment at that particular moment that gets banks to act in a certain way, right? Even capital also shifts in its predatory kind of approach. It becomes very predatory as opposed to let's build together. So at some point, you must have had an account director who was very, let's go. Then it changed when an account director tells you, no. Then I'm going to take you over your business over. So you ask yourself, is this the same bank, same people? Because I think you cannot blame them. I think it's also the underlying macro fundamentals that are affecting the industry, if you ask me. So if I look at my business, when we grew significantly. And banks played a very critical role, equity played a critical role. If I remember buying my house in Roslyn Loan then, banks helped me buy. But when things tanked, and not because I wanted them to tank, it was just bad decisions, political situations that affect your business. We have a topic coming where politics and business integrate. At that point, you don't realize how coupled you are. Everything of yours is coupled together. Your business, your house, your family, everything is all intertwined. You understand? You're beginning to think the banker is telling you, your personal guarantee boss, you've not paid, but this house, we need to sell. You're telling them, what do you mean? You sell my house. But I'm also thinking mentally, where are you? It takes a lot of healing mentally, because if these guys take my house, will I have the energy mentally to even go back and solve the bigger problem? So yeah, they're taking your house for 100 million, whatever it is, for 120 million. But the problem you have with them is 800 million. So if they take your house for 100 million and you go crazy, how are you going to pay the 700, Edwin? You may just decide to hell, let everything burn, right? So maybe they should have left you stay in the house to give you the moral, the energy to be able to still see how do I help you with the 700. Is that correct? Because think about it, many entrepreneurs would say, I don't care. From now on, kila mtu shikilia. Is that correct? Personal guarantee or not, right? So it's a good conversation for us to have around when things don't work out. Mentally, how do you lay your bricks and your cards? Because it's very easy for you to say to hell, I don't care, right? It's so easy. And at some point, you sit with a banker and you're trying to tell them, if you push me beyond this, even me, I'm going to say, let it go. It's the way it will go, let the cards fall the way they'll fall. But at the same time, as we were talking earlier with Christine, you go back and look at the agreements, you realize I can't just say that because it's not as easy as it looks. Because legally, I can't just say let everything fly the way it's going to fly, right? Mm-hmm. So let's go into when it fails, when things don't work out. What goes through your mind? How do you gather resources, people around you, networks around you to help you go through these waters? And Edwin, I think for you, it would be interesting to see how do you navigate that? But I think for me, I really wanted to talk to entrepreneurs because this is what we don't tell guys. How do you deal when things are not working? And we are currently the economic situation in for entrepreneurs is quite difficult right now. A lot of people are going through these very challenging situations. Bank defaults at all-time high. Lending is not happening because money is being prioritized to put money in more safer instruments like bonds. Is that correct?
Yeah.
So today, capital is not as liquid as we would expect. Guys, Americans and Europeans will probably stop funding money here because they're going to take care of themselves first before they put money in our markets. So what do we need to do? Because there's going to be a lot of us crying. Now, how do you help some of these guys? And how can this episode be a place where people can read and watch and sort of figure out, okay, maybe I should not give up?
Okay. I think he gave the answer. This thing, what did he call it?
Pre-mortem.
Pre-mortem.
That also requires a mental capacity to do pre-mortem.
Pre-mortem.
Yeah.
We don't do it enough. Luckily for me, I think in my first crisis, when things don't go right with my previous employer, I had not done a pre-mortem. But now, the business I run, I had done a pre-mortem. And what do I mean? Anything worth doing, whether it is entrepreneurship, a business, marriage, a relationship, career, things will go wrong. There's nothing worth doing that will not experience challenges. So it's therefore important to do this pre-mortem and ask, this journey that I'm about to embark on, what could go wrong? And certainly you cannot cure 100%, but what is it that we can cure now so that when things go south, we are ready? So in my next journey, which is the entrepreneurial journey, we sat a lot with people who had been in real estate, with lawyers, and asked, what is likely to go wrong? And how do we cure it now so that when it goes wrong, we trigger it? And when things go south, that's really the time to test, were we committed to this or not? So for us, we ended up with a way to join this business, whether you are as a client buying real estate, whether you are putting in money to finance it, to be able to tie you in when things go south. So for me, I would say it is to do a pre-mortem, and when things go south, you bring everyone and say, look at this clause. This is how we said we would behave when things go south. So you are in it. The idea of a comprehensive lifestyle mixed-use development, the promise has not changed because we have COVID. Now you want to remove your money. You want to remove your money that you brought for real estate development. You want to back out of your contract for the real estate development that you were buying. I told you to bring money, we would develop. See, here is the land. I told you to buy this real estate. See, here is the land. Now you guys want to leave and leave me here alone. Nobody is leaving. We have to continue the journey. If you have a valid reason to leave, put it on the table, we discuss. But you cannot just say, I've just changed my mind. So for me, Mike, I think when things don't go right, because you always have to, if the fundamentals of the business have changed, then you have to be candid and say, things have shifted. This can no longer work. Like I had a say, at a point reached where buying and selling computers and technology is no longer that profitable. But the promise of mixed use development, aspirational real estate has not changed. So just because the weather has changed out there, because there is COVID or because there is a lot of noise around the brand, now you want to take off. No, you will not take off. We have to walk the journey. So when we say when things don't go right, is it because the fundamentals have changed? Then in that case, you might need to change. I cannot speak too much to that. What I can speak to is if the promise of the journey is still intact, but in between there's bickering, in between the outside weather has changed, for me, when things don't go right at that moment, that is now the opportunity to really test and tell people, were you really an investor? Were you really buying? Were you really an employee? Because at that point, there are people who also looking for opportunities to go work somewhere else, I tell them, please go. I want to stay with those who are committed. And you know, the beauty about being a founder, you came in day zero when you didn't have the head of HR, the head of legal, the head of finance, the head of development. So when they threaten you with leaving, you say, but I came here when you were not there. Please go, I will start afresh. So for me, the solution when things don't go right, if the promise of the journey is still there, that is really an opportunity to really test again why I started the journey. And the solution I've found when things don't go right, that is the time for renewal, to recommit and tell everyone, I am still focusing on my true north, which is to deliver aspirational real estate by going directly to the financier who would have given the money to the bank. I'm telling them, give it to me. I am still delivering. So in summary, when things don't go right, that's an opportunity to renew and still push for the promise of the journey.
That's an interesting outlook, because guys, we sign contracts. The investors, and this is very interesting, especially around angel investing. Angel investors sign. They also, some of them are quite bullish that the idea is great, but when things don't work out, they forget that they invested into a venture that could also go belly up. The same capital they put in your business, they could have put in a stock market. Let's say you put in Tesla, and now that recently what's been happening in Tesla, maybe you lose market share. What happens? Do you pick a phone and call Elon Musk and say, my friend, me, I want my money the way I invested? You see, that's also the discipline of investment is not there. You, Edwin, people are going to call it and say, you, Edwin, we want our money. Because they can't. But if they invested money in Elon Musk, they won't call Elon Musk and say, what happened here? Or they invested money in KPLC, they're not going to call the KPLC boss and say, you know, guys, what happened here? So that's also something that people need to learn, right?
What I find is that people, okay, there will be, remember these guys who give you money, let's be candid, they are investors and they are also speculators. Those who invested will look at you, the strategy and how it's unfolding and ask, did the entrepreneur do what they say they would do? Things have gone south. That is investment. How do we then get on a table now to either salvage what we can or to correct the course and take a new course? Mm-hmm. Those are investors. But they're also speculators. Because when we talk about investment, people talk about what they will make as opposed to what they could also lose. Now, what they could also lose has now arrived. Speculators will quickly now find a way. They might not be able to call Elon Musk or KPLC, but they'll find a way to make it look like Elon Musk or KPLC has done something wrong. Mm-hmm. If they can call you as an individual, then they will call you as an individual and say, oh, this is not what I expected. When you tell them, okay, now we are bickering. Can we pull the contract? Oh, those you guys foresaw these. Those are fraudulent contracts. We don't want to read them. Trying now to avoid the difficult conversations, and they're only focusing on how do I exit this risk at this particular point. But once risk arrives, you cannot exit. And then that's why then quickly people find themselves in court, because now you're saying we can't agree. Let's go to a neutral party, so to speak, because some of them are not neutral. They will find a way now to go behind judiciary and try to get... The point is, I still think trying to figure... Because even if you were to get a judgment and you cannot execute and walk away with anything, how does that judgment help you? It would be good for entrepreneurs and investors and people around the strategy to say, things have not gone right. How can we constructively, collaboratively, course correct to a place where we will salvage the most that we can, or we will still complete the journey by amending how we get there?
And that's great, because that's a great conversation, because I think if we dovetail this to Christine, you see, we've said when things are great, everybody is on board. Mm-hmm. So at what point do you think when you're getting partners on board, you're able to start having the uncomfortable pre-mortem conversation and say, guys, if things don't go right, are we still going to sit on this table and have this champagne? Okay? If things don't go right, how do you know that the partners you have are capable of having that conversation? Mm-hmm. I've been through that journey. And I know when things became uncomfortable, some of the big players in my cap table, when I had to make very hard decisions, opted, they want out now. At whatever price, they want out. They don't care what price, we want out. Because the decision I'm about to do is best for me and for the business, but not best for them politically. So how do you know that the partners who are with you, okay, based on your experience, are going to be with you in thick and thin? How do you align those capabilities? Maybe you could speak to that, because that's somebody somewhere is trying to get a partner on board. It looks great, right? Until you get into chaos. And then you realize this partner was never the person I should have taken. And sometimes I would rather take a lower valuation with a partner who is going to stay with me longer than a higher valuation with a partner who every day has put a gun on my head saying, I've paid you so high valuation, I want. Now, how do you convince the entrepreneurs that rather take a lower valuation with a partner who is longer term than taking a higher valuation with a partner who every day is going to be a problem? How do you mitigate, and how would you sort of talk to us around that from a legal point of view and also from your experience?
So this is where I spend most of my time with founders and people in business. I say before you sign any document, you need to discuss what will go wrong, clause by clause, and you have to. When you're having those discussions, say for example, you have to say, if this goes wrong, how are we going to deal with it? And in the process of having those discussions, you'll get to discover the person you're dealing with. And then you have to decide, are we aligned in terms of business values? And when you've had those discussions and you've gone through pros and cons, then you can make a decision and say, this is a person I can do business with when things are good and when things are bad. So that's what I would advise business people. Have the discussions, the post-mortem, because we already know. The beauty is we already know things will go wrong. We already know 80-90% what will go wrong. So there's no new information other than few technicalities here or there. We already can predict what exactly is going to go wrong. So I always advise, before you sign the contract, have those discussions, agree on those issues, document them within the contract so that the contract can be flexible, it is practical, and it is also corrective.
And that's interesting because, Bobby, interesting you say that, because from my experience, I think on this conversation, and especially now looking at both investors and financial institutions like banks, I feel what I've experienced, what I know is that there are certain financial institutions that lend you money, but you know they're very predatory. You know, when things go wrong, these ones, they're going to be things are going to fall apart. And we all know, right? And there's some financial institutions, you know, they may not be as aggressive, but they will try their level best to work with me until. So that's also a culture based on the person you're about to entangle yourself with. Correct? It's a culture, right? But now, how do you balance between, I really need this capital, okay? It's a very emotional thing. How do I balance between, I really need this capital vis-a-vis the person I'm about to entangle with? I know it's mafia here.
It's not a balance, it's a decision. Because we know banks, we've known for years what happens if you default in any manner. I don't think it's a balance. It's a choice you make. I know this is where this can go. Am I willing to take that risk? It's not a balance because it's more of a competing priority. Which priority ranks higher? What are you valuing more at that particular time? So if the founder is thinking short term, then obviously the risk is going to be higher. If the founder is thinking long term, then they are going to be a bit more risk averse. So it's what ranks higher at this. Am I short term or long term vision?
Yeah, there's so many things you have said that triggered stuff that I'd like to share, if I may.
Yeah, sure.
So there are a couple of points I have, and to this one, you know, entrepreneurs are faced with making decisions every day. She talked about choice. To answer in a short answer, you have to choose your hard. Which hard are you going for? Because if things go south, we know this is going to be a problem, right? If things go north, great. There's a choice, but you're not sure. Obviously, as an entrepreneur, we're still thinking optimism. So we are making the decision based on
But Bob,
the north.
to add to that,
Yeah.
the contracts usually outline what will happen when things go south.
And
So
Absolutely.
when we're talking about optimism, say even in facility agreements, it will outline, if you don't do this, these are the rights of the bank. But all borrowers proceed to sign those contracts.
because we're so optimistic that south is not going to face us, but it does, right? So we are choosing a hard and we're prioritizing, like you said. But there's other things that I want to say. Like first, you know, there was a time when you were talking about optimism when banks were lending and there was development and everything. You got to remember, banks are also a business, right? So it's a business. Interest rates were high. They were giving money freely. Which regime decided to interest cap? Remember, when I think it was the Kenyatta regime when he came in the first term, and he says we're going to cap the interest base lending rate plus 4%. That time things went south, because now the banks are saying here at 4% we're not making money, so their risk appetite dropped. So money became tight. Once money became tight, the down spiral starts. Because when money is freely available, right, you can use it as a remedy or as a patch because you have access to it. But the moment the interest capping happened and the bank's appetite for risk reduced, that spiraled a lot of problems. That was one of the things you mentioned, Nakumat as well. I can tell you clearly, when the money stopped coming in for them, the problem started unfolding, right? So that's something to look at. So because it's a business, they are tough on us, right, when things are going south. So this is the risk we have to take. If banks are making good interest rates, then they'll be a bit lenient on you. They'll be lenient on you for a longer period. Then when they are done making any money, then they're going to be predatory. They're going to come and hound you. Which comes to my other thing is that if you're looking out there for raising capital, we talked about angels, right? You have seasoned angels and you have new angels. Like me, I don't have the appetite to be an angel. I'm telling you now, I cannot become an angel investor. But I know people there who are seasoned angels. And what I mean is these guys, angel investing is like gambling, going to the casino, right? A seasoned angel knows it's the game of numbers. I am going to invest in 10 businesses, whatever the amount is, whether it's $1,000 or $100,000, that's irrelevant. I'm going to invest in 10, knowing that one or two are going to become those unicorns or will succeed. And they will cover up for all my losses. These are what you call mature investors. They are not the guys who will panic when, your COVID has happened. They are they understand this. But then you have the speculator investors and the very new investors who say, oh, you know what, I've got what it takes. I've got a little bit of cash. I know I can do this. And I've seen people do it. They are following the herd. And I say, I'm going to try this. And those are the guys you want to be careful of. And so you had said a point earlier that sometimes when you're getting this money, you need to interview the investor. You need to know more about them. They are doing all the due diligence on you. Are you doing the due diligence on them? Because if you're lacking to do the due diligence because you just want the money, then you're going to face huge problems when things go south. Right? If they're going north, great for you. Good. Enjoy it. But now when things go south, like Edwin, you were saying, when guys, you have promised, the promise is the same. You're giving that aspiration of good living. That nothing has changed. Right? Your goal is there. Maybe your tactic has to change. The strategy has to change now to maneuver and to adjust to the environment. But that guy doesn't understand that. Because the pressures on him are too high. So he now comes and put pressure on you. So I'll be telling your founders, do due diligence on the money that you're bringing on board as much as you can. And if you're not good at doing due diligence, it's okay, because your skill is something else. Go look for the person who knows how to do that due diligence. Seek that advice. Go get the lawyer. Go get the investment banker. Go get that friend of yours or your cousin who brags about how much he knows about money. Tell him, come and do due diligence. You think this guy has the emotional intelligence to invest in my business. Now you may avoid those pitfalls, right? Because you don't have this pressure cook on you, right? And now you may have a startup idea. You have a good idea. This is another point, right? And I keep saying this to anyone who cares to listen, right? First of all, you want to raise money. Okay, fine. I understand you need money. You want to raise, especially the startup world, which we are in now, and we think raising is a cool form, right? Everyone's talking about a $5 million valuation. I raised $3 million. I raised $2 million. I raised $500,000, right? Oh, number one, why do you want to raise? Are you raising because it's become a trend? Do you want to look cool on social media or socially that I raised capital? Is that why you're doing it? Because if you're doing for those reasons, then you're not in the right reason in the first place. The raise is there to help the business to grow, achieve your vision, not to use as bragging rights that you raised. Then you're already on the wrong footing. Now, supposing you raise the money. When things are going north, everything is going well, that money is being used well, it's great. We've discussed this again and again. But when it goes south, this is a problem. Now, what happens? Now, nobody apart from you is interested in your business. Not the banker and not the PE or the VC fund that invested in you. They're not interested in your business. Their business is to make a return for their investors and their shareholders, right? So they're interested in making money. Your business is a tool around it, okay? Now, how do they know that they're making money when they invested with you? There has to be a method, right? So what they do is they look for other investors to come and buy into your business at a higher valuation than they had bought, right? So if they succeed in that, they know their investment was right and it's growing. So let's say they've invested in you $1 million, right? And you went into the market. They invested into you when you were $5 million. Now they want to raise another $1 million, but they want to raise at a $20 million valuation. And they succeed. Now they know their money is growing. Okay, great. Up to this point, we're all good because everything is going well, the money is doing good. But now, what when things go wrong and these people want to start exiting, right? At some point, they have to exit because these PE funds have money for 5 years, 7 years. They have to show the return to their investors. This is a reality.
Interesting, because I think I want to go to Edwin, and I want to talk about pivots. You know, in my life, I think part of it is sharing, as we said. There are moments when I've been very successful in pivoting the business. You know, you pivot. So let me give you an example. When Safaricom was about to buy my business, Safaricom controlled 80% of my business, 80%. We were doing $1 billion shillings revenue with Safaricom as a local company. That is in 2009 or 8. So when this transaction of acquisition never happened, there was a change of regime in the organization, as you can imagine. There was a lot of shake-up in senior management. So even my business got significantly affected, not because I required senior management to do business. It is the way people just do business, the people they like, whatever it is. So my business moved from $1 billion shillings Safaricom revenue to less than 100 million within a year. That's a big, imagine, because you have like 80 people all attached to Safaricom. And you can imagine this is a company that was top at the technology level that there's nobody else implementing what they do. So the kind of skills that you have, it's only a telco that can consume that capability because you've overtrained these individuals. Anyway, so we then pivoted into government and then came up with the whole idea of Huduma centers, which became government. And I thought, okay, let me pivot to government, let me see how it goes. Then eventually we moved into healthcare, pivoting into healthcare. But the investors were there. Every day we're thinking we're going to exit with Safaricom, we never exited. Now let's move into healthcare. Okay, what is the guy about to do? We were successful in healthcare. Okay. Let's move further in healthcare. Let's move into healthcare automation. Great. More investors coming. This is not looking bad. And now you're moving from institutional and you're sided with some PE investors. Now you again bring another set of PE investors. because you're trying to do what you call a private raise for this investment. And now when you move your cap table from 5 people, now you've got 30 people. I mean, it's worse. Is that correct? Now it's even, because everybody is looking for that big payday, as you said. Then you reach a point where now everybody's happy you're pivoting, right? Then things don't work out. Okay? And now you're no longer, your runway of pivoting has run out. And now your only way out, because you've hit this end of the runway, is to say, can I jump into another runway and start a new business, right? And the biggest challenge, I think, for me in that whole journey of raising capital was mentally telling myself, how will I jump into the new runway and convince another set of entrepreneurs or founders, not entrepreneurs, investors, to believe me when I've left this plane parked in the end of the runway. Because remember, we were on another journey. We were going to take off with this 747. Government happens. As you can imagine, government canceled your big contract, $50 million. Everybody knew once we implement this project, we can replicate it across Africa. The sovereign funds of some countries were already talking to us. So we knew, Edwin, you can imagine, you as a banker, if a sovereign fund is talking to you as an organization, we invest in you, you're trying to become, you're almost like your case study of a company in Africa for them to invest in. So now you're thinking, I'm in a new runway, I have to convince these new shareholders that I'm still bankable. Mm-hmm. You know, it's such a mental thing in your head. Because, you have to start with the same investors, as you're saying, and they're all different. There are some that are gambling, there are some that are mature, and now you've got a whole set of 40 investors. Now you're telling them, let's go back into this journey. That's where we are today. Now, the issue of pivots, why I'm talking about pivots, we start with a story, and Edwin talked about, it's not a journey. We all agree, you bring this to the table, I bring this to the table. This is the big idea. We are doing housing, whatever format you put in it. Now you're trying to think, this is not working out, guys, for whatever reason. Could be economics are not working, COVID came, government, this happened here, or whatever is happening, right? And now you're thinking, I need to pivot. Now, what I've found, and I'd like you to talk about pivoting, how do you carry investors along with you who, number one, came in because of an idea you had? Now you're trying to tell them, we want to pivot. And they're telling you there's no way of pivoting. What are you talking about pivoting? What is this? You're changing our whole ideation. And I'm telling them, Amazon said it's selling books. Now it's the biggest hosted digital hosting capacity, Amazon Cloud, right? Mm-hmm. Now you convince an Amazon investor from a book business to an e-commerce company to selling Amazon Cloud and Amazon movies and Amazon everything, right? Prime. You think about the investors who cannot even mentally understand that pivot. Mm. How do you carry investors with you and also help investors who are with you and you really need them? And they're good guys and they're really committed. They're just passionate and maybe they're disappointed. But you're telling them, guys, hold on, let's pivot. Mm. It's going to work out. How do you mitigate mentally that whole engagement and conversation so that they stay with you? And I think there are many companies that are going to face that problem. Mm. Where you started with an idea, you sold, the guys bought into it. Now you want to pivot, they're telling you we're not going to pivot. Okay. And clearly if you don't pivot, we're going to die. Mm. So what do? With passengers on a flight, you're the captain, you're telling them, guys, please, I know the instruments. But they want to jump into the cockpit and say, even me, I'm a pilot. Mm. Tell them, you don't know how to fly this thing. Let me fly this thing. Eventually they jump in the cockpit and you all crash. How do you mitigate that position?
Now, Mike, before I come to the pivot, because I think randomly, let me make a comment about personal guarantees that you've talked about, losing a house, or the house being threatened.
No, house went.
Okay.
We'll buy a new one.
Now, I've been lucky. Okay. I've never lost a house, not because I was not in a position where the house could be lost. I always think a lot about the downside, because there will be a downside. In taking loans from institutions or from anyone, I've only given a personal guarantee once. It was to a landlord for rent. And I looked at it and I said, in the worst case scenario, this is a personal guarantee that I can meet. So I always tell entrepreneurs, when you want money, like you want a mortgage, in most cases, the bank will not amend anything there for you. So you decide, do I want this mortgage? I will sign. So do I want this capital? I will sign. For me, the one thing I never sign is a personal guarantee, because when I'm signing a personal guarantee, I'm now looking at that discussion with my spouse that we are losing this house, that discussion with my daughter that we are losing this house. And because they are not seated when I'm negotiating with the bank, I feel that there's an element, to put it quite frankly, there's an element that I will be conning my family. Because they are not seated here today, but the day things go south, my daughter is called Zara, that's when Zara will realize, oh, you mean that the house is being auctioned? Yet she was not on the table when I was negotiating with the bank. Okay. Now, we always, when you need money, emotionally, you put yourself in a disadvantage. The bank is not facing you for the love of you or for your business. They've looked at many other entrepreneurs and they've decided, I think there's a future with this person. When that owner of that small bank gave you the card and called you, because you need money, you'll feel like, oh my God, they're doing me a favor. They've looked at many hundreds and they've said, you know what, these PC world guys, I can see. Because remember, they're collecting money at the branch every day. Now, they can't collect and put it in the vault. They have to lend. So you are bringing value. So entrepreneurs always forget that, look, I am bringing value. The reason why this landlord is willing to look at my application, they have hundreds of potential tenants, but there's something they see in me that I don't see in myself. So for me, I always told myself, I will never sign a personal guarantee. And there's a case where a bank sent me a personal guarantee. I said no. They came back and accepted the corporate guarantee. So it's just a place I've told myself that when business goes south, things are so bad. I don't want to be in a point where I'm also wondering about my bed and the roof over my house. So that's where I draw the line. I say, no matter how good the terms are, a personal guarantee I will not put on the table unless I am sure I can meet it by myself and it will not affect my daughter. If it can affect my daughter, I say, let it go. And what I have found, actually, when I look back, all the cases, I would say 100%, where personal guarantee was part of the deal, and I said no, those deals came back. So emotionally, an entrepreneur has to realize, I'm not seated across this bank or across this VC because they love me or my business. There's something they've seen in me that I don't see in myself. So I have to draw the line. And for me, where I draw the line is things that will personally affect my ability to take my daughter to school or for a place for her to sleep. I just won't go there. Then the personal guarantee I'll give is what I can meet. So I would actually tell investors, don't give a personal guarantee unless you can meet it. And if the other side insists in it, I don't see what a financier would gain by the entrepreneur having personal, emotional, sleepless nights because their family is being thrown out of the house they live in. If it's a personal guarantee that can be crafted to be other investments, that's fine. But the house that my family is in, it's not worth the capital. I will get it out. That would be my view. I'm just sharing my experience because I'm also sure there are many other entrepreneurs who've given a personal guarantee and things worked out and they will advise others to give personal guarantees. For me, I always say, think of when things go south. The next point I wanted before I go to pivot, it has a story similar to personal guarantees. Mike, when you talk about the business is booming and the person the other side is the government, I would ask, and these are discussion, we don't decide who's the government, the voter does. And how the voter thinks, we don't know. So when I'm going to get into business where government is my main counterparty, I would imagine I would have to ask myself, but what happens if this government changes or if they turn around? That means my business is screwed. So it will be good the day the government is delivering. But I've always said, for me to do business with government, I would want one of two things. Either I have a partner who knows how to deal, not with this government. They have a track record of dealing with every successive government. because I don't. They need to be able to do that. Or on this side, I have a shareholder of an interest who's also a government that can talk to that government. We took the decision when we started our business that we will not do government work, as attractive as it could be. So, for example, affordable housing, we will not touch. Not because it's bad, not because there is no money to be made, but I can't just imagine, for the few times I've had to sit at the lobby of a government officer for things that I could not avoid, such like licensing, for example, such like intervening. Now I can imagine if I wanted a check from government, I just don't think we would be so good at it. So for us, we've taken the view that, look, we don't want to deal with government business, not because it's bad, it's very good business, but we are not good at it. So the point I'm trying to make is, whatever business you are doing, think of the downside. At that moment where government is your biggest payer, ask yourself, how will the world look like if abruptly this same government turns against me for whatever reason, or this government changes? Life becomes very difficult. So always think about the worst case scenario, your biggest supplier, your biggest buyer, your biggest software partner. What happens if this person turns against me? You need to be able to have a plan B. Coming to your pivot, I want to talk about personal guarantee, then
And I think
government business.
And even before you go to pivot, because there's something you've said that is very profound and that has rung back, but don't forget about the pivot conversation. Do you know that I think when the other party, on the other side, becomes faceless, then you have a problem. So you start a bank, and I'm just thinking about it. Even when I get a bank loan, at that point, the CEO or the director was somebody who really believed. I felt there was a face to the bank and to the individual who was going to sign that bank loan. Even the PE fund that invested in us, at the point before they sold or they went to the next guy and the next guy, even the PE funds keep selling. The guy who was signing the deal at the first time had a soul with a connection.
Yeah.
A connection, right? Now, what I feel is government has no soul, has no face. So today you're doing business with Ministry of Defense or Ministry of Health. The minister there, he's just temporary figurehead, right? They can do anything and disappear tomorrow. And the next guy has no face to you. So I feel, and maybe to a way of testing that theory is asking yourself, the person I'm about to sign this deal with, if they mess me up fully, do they have a soul to figure out, do they really care? Now, you realize government, as you said, nobody will care. Who will care? Okay, today we owe, the private sector is owed billions. Who really cares? People are killing themselves. Banks are repossessing houses. Who cares? Tell me. Who really cares? If you think about it. Me and you care. It's affecting a lot of us. But even the bankers who are banking you because government has delayed to pay don't care. And they're in the same market, lending the same government money. And you're telling them, you guys, you're not getting paid. You want to auction me. You know government owes me money. And you want to auction me.
And you can't auction government.
And you can't auction government. But you now are lending the same government money. Like, what is in your head? So it will take a bank that has a soul to understand you. The bank has to have a soul. The moment the bank lacks that soul, and they're willing to auction you on the basis they clearly know you're owed money by government, and then themselves are lending the same government money on bonds, they're not coming together and telling government, come on, as banks, can we sit and tell this government, we cannot be lending you money unless you start paying bills to SMEs. So they would rather keep on charging interest until you hit duplam, double interest. So the bank is making money on both sides, making money on your pending bills because they lent you money. On the other side, making money on treasury bills. And then at some point they'll tell you, now we want to auction you. We've reached a point where we don't even know when you're going to get paid. But I'm telling them, why don't you come together as banks and tell guys, at least you care. Let's go and tell the government, pay these bills at least, Jameni. For every money we lend you, we expect at least 30% you're paying pending bills. You understand the challenge? So coming back to your question is, what I was trying to say is that when the party on the other side doesn't have a soul, then you're doomed. Because it's you and yourself. right? When the private equity guy, CEO changes, and the new guy comes, even your biggest customer, and I was telling you about Safaricom, for instance, when the new CEO came on board, who is this company we're trying to buy? Why are we buying it anyways, right? You see, now there's no soul conversation. Now it is throw this deal into the dustbin, and it goes, boom, and you say, I've been doing this for how many months? 9 months, trying to close this deal. Now all of a sudden it's in the dustbin. Like, how is this happening, right? So you see, it's about that connection. Maybe that's the thing to figure out. Is the person you're working with, do they have that connection to you?
And I would go further, Mike, and say, it's a good analysis, but also try and look at how will the world look like when this person who has a soul disappears or becomes soulless. It is, I think, one of the things we don't think a lot as entrepreneurs is risk assessment. So I'm dealing with a person who has a soul, but I'm not going to bet my business on his soul. So how will things look like when, for whatever reason, they lose the soul or they are switched over? Because once you look at the world that way, the government will change, their soul will change. When that bad time, and it will come, then you say, I'm prepared, because when now the government change, this is what I was going to do. When the guy with the soul now all of a sudden loses their soul or is replaced with a soulless person, this is how I'm going to go. So I would summarize it as just continuous and rigorous risk assessment on a daily basis that you do between yourself and your top 2 or 3. How will it look like when this chairman who's really backing us one day now, for whatever reason, hits the bucket? This government that really loves us, what will happen? This software company that is really backing us, or this, what is it called, lines of credit. You know, this guy can just wake up one day and switch it off. How will the world look like? Once you think about how the world looks like when your biggest supporters walk away, the day they walk away, you say, that risk has now arrived. Let us now deal with it. When your personal guarantee is called upon, you say, now it has arrived. How do I deal with it? You don't deal with the risk when it arrives. You deal with the risk before it arrives.
But even before you go to pivot, how do you build that ecosystem, internal DNA, to help you think that way? You know, there's a book by this guy of Intel that talked about how do the paranoids survive? How do you survive in paranoia, you know? So you constantly are thinking, if things don't happen, okay? If things don't go as I planned, and you know, as entrepreneurs, we're already extremely bullish. We're extremely positive. So you're telling, it's almost like rewiring your whole DNA, your blood system. You're telling yourself, I need to start thinking downstream. I need to understand, I need to start thinking if things don't happen. How would you encourage? How do you think? What does it take, if you think, what does it take for an entrepreneur to switch into that thinking? Is it going through some significant tribulations? Okay, some significant near-death moments as an entrepreneur, some crucible moments that makes your mind move into that caveat, into that way of thinking.
Sorry, yeah. I mean, that point, entrepreneurs work very solo. And what I realized, when things were not working out well for me, I was lucky enough just before, when things were about to start going south, that I was involved. I was part of entrepreneurs organization, and I was in forum, and I had these 6-7 people were sitting next to me, right? And we would discuss business and stuff in a very confidential environment. And I'll tell you one thing that pulled me through. Unfortunately, this thing came a bit late. Had it come sooner in my life, I may have saved a lot of these things that you're talking about. As entrepreneurs, we don't take risk very seriously, because we are always thinking of growth, and we are very positive and optimistic. So when I was going through this, I had this support mechanism of 7 individuals. They could literally be called my board of directors, but with a bit of an emotional attachment to see this thing through. What saved me later on and pulled me through what I was going through was this support mechanism. And to your question, Mike, is, you know, if I were to get this realization on my own, then it's going to be too late. That near-death experience will wake you up. So what I'd be encouraging entrepreneurs to do is seek for guidance, seek for mentorship, seek for coaching, one, right? create a support mechanism of trusted people who don't have a vested interest in your business. They don't have an agenda of financial gain around you. Now, that's going to be another conversation. How many people are there that are going to genuinely be there for you to give you this kind of support, right? So if you can do that sooner in the journey, then to your question is, how do you rewire yourself? It will become easier when you're hearing it from like-minded people who can guide you through that process. But what happens is, like in my case, it came a bit too late. But it was never too late, because that support mechanism helped me get through a very dark phase of my life, which was the business was crumbling. At the same time now, when business goes down, I remember my lawyer friend asking me one day, we were having lunch. He said, by the way, how's your relationship with the wife? I said, everything is fine. Like, I was thinking, why is this guy asking me this?
But the point is now, because we need to come back to Christine, but I really want Edwin to go through the pivot conversation. Something you've said about stakeholder management. When you took that personal guarantee, when you took that loan, you didn't bring your son and daughters and your wife to the table. You took it, you signed it. And very few people survive that whole home institution. You call it your home. You said you never sign. Trust me, don't sign. The moment they sell that house, and the identity of the family is that house, your marriage won't survive. It's very difficult. Trust me, because the identity of the family is that household, and especially with something you've all put personal touch into. But the bank doesn't understand that, because your emotional toil as an individual, the moment that you go through that, if it takes a very special human being to go back and say, I'm going to go back into the arena and keep this, because your whole value system, your whole support system is crumbling. But the bank thinks by doing this, they have solved one problem. They think you're sort of immortal. You wouldn't die as an entrepreneur. Not realizing the more they do this, they're breaking you. It'll just matter of time before you break. And if you're the only guy who they have signed personal guarantees with at a 2 billion bob, the moment you die, the 2 billion shilling goes. So I think it's a stupid fallacy of, let me put the pressure on this guy, because the moment you get to that point of cracking, and some guys will even commit suicide, what happens to your 2 billion? You're gone, right? So I also think the guys at the other side of the party, the bankers or the guys who maybe represent the private equity, maybe some good MBA guy who is sitting on your board, or some banker, they lack that understanding of what you're going through emotionally. And they don't realize at a certain point, they'll put you the tipping point where it'll become a bigger liability to them than to you. Because they'll ask you have a 2.5 billion shilling debt with the bank. So they have loaded interest, they've done all the nonsense and everything else. You're now at Duplam, you're everything, letters, it's really paperwork being pushed on email, on lawyers. Lawyers have loaded their fees, auctioneers have loaded their fees. Everybody's just loading everything, right? Now they're putting your soul onto it. So at some point you'll tip, right? And that's it. The law agreements you'd signed don't matter anymore, right? And you see a lot of banks eventually writing off those kind of loans. Even investors writing those kind of loans. So I guess it's also a call to action, and I hope that, and I think why we're doing this, it's not only to founders, it's also to help the institutions and entrepreneurs, and people who are also in the capital game, to also understand the impact giving that capital does to an individual in terms of mental health. Yeah? You think it's easy, you've just signed that check, immediately do that, it's golden handcuffs. Then eventually it becomes an emotional connection, right? And it becomes an emotional game to you. And you're always thinking, wow, what if I fail? What if this happens? And I think that's where Pivot comes. I really want to listen to Pivot, because there could be a lot of entrepreneurs who right now need to pivot. But everything, when you go to a board, another problem as we come to this is they tell you, keep informing your board or keep informing your investors on what you're doing. Transparency. So you are a very nice guy. You keep updating everybody. Eventually, that information, the same investors start to use that information against you, because you give them too much information. And what happens with somebody who has little information? They take the little information that they have, they do a little bit of ChatGPT research, they come back with some information. Now in a meeting, investor meeting, you're saying, okay, where is this guy going in this conversation, right? So how do you pivot and get people around you to pivot and not pull you back? Because what I've found out of 80%, if you've got a pool of 40 investors, only less than 15% will accept you to pivot. That's the number I've looked at. That's less than 10. If you have 40 investors, less than 7 of them are going to agree, let's pivot, have the courage. And what I've found also at a global level of investors is investors who will pivot also come from countries that are known to deal with adversity, for instance. So I've seen my cap table. Investors from Israel have a very big affinity to pivot. Interesting. Yeah? If you take European investors, pivot is not their business. Please. Americans, yes, let's go. Asian people, yeah, we can pivot. Kidogo. Africans, yeah, somehow, right? So even your cap table, the kind of investors you have, you also need to understand their upbringing within their country, how they look at risk, also determines the level of how they tell you to pivot. So coming back to you, Edwin, how do you pivot? How do you convince a whole lot of people with capital to pivot? And sometimes you want them to invest even more capital to pivot.
Mm-hmm. Mike, to be honest, this is a difficult one because I'm not sure I truly believe in pivot, because my entrepreneurial journey has always been, give me capital, I'll put into real estate. Now, there are times when a bank is on the table. There's a time when an institutional investor, we had an institutional investor who put almost 3-4 billion behind our business. Now they are not on the table. There are times when retail investors are on the table. So I would be able to talk about pivoting in terms of changing investors, but not yet changing the strategy, because I've never been at a point where I have to change the strategy. Now, the way I hear the question is, if the strategy were to change, I really would want at some point to hear the PC World story, because I would imagine things moved, but the strategy didn't move. But the example you've talked about, Amazon starting to sell books, then realizing, okay, if people can buy books over the internet, then maybe I can sell other things, then selling a whole range of things, then realizing, wait a minute, but to sell all these things, I need cloud. But this same cloud that I need to support my books and all these other market, maybe other people need it. So let me see if I can commercialize it. So in the case of Amazon, I see it less of pivoting. I see it more as growing and seeking opportunities around your core strength. Because if you take the story of selling books to selling everything to cloud computing to whatever, I'm sure they're currently figuring something around AI. The theme is the same. The theme is capabilities around technology. And how do I monetize that capability? I don't see Amazon saying, look, we're having trouble with these books issues, so let us leave selling things over the internet and let's get into construction. If it's that pivoting of, I'm going to move away from my core capability and see where I can make money, I wouldn't say it doesn't work. I don't have a view on that.
No, but it's the one where you remain, your core competence is there. It's exactly the Amazon. The other one that's not pivoting. That is that's whatever you want to call it. Pivoting is you're within the rails. All you're saying, I'm in the rails. I've been doing passenger. I do cargo. I do. But the rails have remained the rails.
So for me, the one that I've experienced with is now pivot. Maybe it's actually then the question you're pivoting around the financier. We've been able to move from here. Our first financier was an institution from Finland. At some point, they were not on the table. Then we brought in individual high net worth investors. Some are on the table, some are not on the table. Then we brought in banks. Sometimes they're in, they are not out. I would say then it's to just, my experience is have different groups, and at any particular time, because if the rails are sound, there'll always be someone on the table who's willing to have that conversation. So it's having a diversity of financiers who you can talk to at any particular time. And when one sees, like, for example, when the the individual institutional investor is having issues sometimes it has nothing to do with you, sometimes it's their own internal processes. Then they see, oh, a bank is willing to come in, maybe I'm not as bad, things are not as bad as I thought, let me give them a little bit of time. When the bank is at some point worried, maybe the individual high net worth investors will come in. I think as long as you are within the rails, as long as the strategy still makes sense, you are still committed, you are executing, you will be able to move from books to everything in the market, to cloud computing, to something to do with AI. So I would say it's just staying to your strategy and executing.
That's interesting, but I guess we have all agreed if you remain on the rails. But again, also the conversation on the rails is not for everybody, because if you had some investors that were speculative, they don't like this rail conversation. They're just very clear. We got here into passenger, we want out, right? If you have a more longer term guy, they're going to think about the rails. So the question is how you balance your cap table in terms of who will remain with you because of the rails, or who wants to stay with you because I want to be the biggest passenger rail company. Yeah, how do you? Those two are two different conversations.
Sorry to come back, Mike. I want to give my colleagues a chance, but I think we should not avoid the ugly part of investment. There's a point to tell the speculator, I am sorry, but now we must have a fight. That's when now you call the lawyers and Christine and you say, I must get this person out of my room now because they are being destructive unless we can redo this. So there's going to be moments that are going to be ugly and you're going to go at each other until we had such a situation. And I'm sure if you look at the internet, one of our partners I won't mention them, but you can go check. We had 3-4 months of fighting until we now said, okay, let's go to a mediator. And we went to a mediator and everybody put their issues on that. And it ended up being personal issues. When we started the journey, this is what you said. When we started this journey, this is what I said. This is how it has evolved. Then the guy said, okay, you can continue fighting or you can. The way I see it, each of you has to go their own way and you find peace. What is it that you want? So there will be moments of fighting, but fight knowing this is what I want. I want the person either to recommit or to leave. The person then has to decide, do I want to recommit or I want to leave? Once they have given you their view, I want to recommit, then now you have a recommitment discussion. If they want to leave, then you discuss the possibility of how they leave. So we should not run away from ugly fights if we must have them. If you don't have to have them, don't. But once you realize this particular stakeholder is now being destructive, I want to continue the journey. It's non-negotiable. Now let me face them and figure out how they want to deal with this particular issue. And when you face it, you don't know where it will go. It might end up in court. It might end up in social media. You don't know where, but be prepared that, okay, now we are going to duke it out with this particular stakeholder.
And I want to come to Christine in a very interesting question. And I like what you've said about confronting the brutal reality. It's like you have to deal with it. I've seen it also in my 7Cs business, when at some point I had to confront the investor and say, okay, now I need to go to court and sue government because really this can't happen. To be honest, my shareholders were against me. Can you imagine? It's 80% of my cap table said you cannot sue government. I said, but I've not done anything wrong. They've canceled the contract. How? What are you saying? 80% said we cannot move. And 70% decided to exit. Whether or not we win, we lose, we are out, Michael. Bye. Deal with that issue yourself. We're not going to be with you. We are moving. And then eventually we went and we had merit. And what had happened was totally just abuse of power. And we eventually won in court. Now, subsequently, we've never gone back to re-engage and figure out, do we understand what went on, how it went on? That is them and they got to deal with it. Is that correct? But then coming back to Christine is to say, okay, you also, beyond being a lawyer and running your legal firm, you're also an entrepreneur. For instance, recently we were sitting with Christine and in one of the restaurants, and I saw in the menu, and she said, "No, I supply this. I supply this this non-alcoholic tea. I said, we supply what? I said, you're a lawyer. What are you getting you supply? So we checked the menu. She had a list of products there, like an alcoholic tea, which here we are testing this one here. And I thought to myself, hey, Christine, hey, how did you get into this alcohol business? You're a lawyer. Are you supplying an alcoholic? Why are you doing this, right? So I figured out, I wanted to ask her, like, and my question to you, Christine, now, so on one side, you're a lawyer, you're a managing partner in your firm. You pivoting from maybe working for a law firm to setting up a law firm which has your surname. So it's not your like your law firm is, you found some guys who told you, come and let's become a partner, LLP partner, and then join us. You've decided to take a journey where you build your own brand or you bring other partners. Number two, as you're doing that, you're also becoming an entrepreneur, okay? In this whole capital arena, right, how are you managing that, especially in your business, with a service business? And my second question to you, which is very important, I think, is that a lot of angel investors invest as individuals, others as families, trusts. Now in Kenya, a lot of families have not created a way of investing. So it is Bobby as Bobby, who comes and invests in the business. Then something happens to Bobby, God forbid. The wife is calling you, hello, pesa ya Bobby iko wapi? Give me back my money. How do you advise family institutions that are investing, right, to create vehicles that help them, and also you as an individual or a company or a founder getting money from an individual, how do you make sure that in case anything happens to that investor who is an individual, that the family doesn't come to you all over guns blazing, they want their money? Because their ethos of why your father invested, and most of them tell you, we want our shares out now. You know, they don't have access to the shareholders agreement. They're telling you, I want to cash out now. They don't realize that your business is not a stock market company that you just go sell shares, buy shares. It's a whole process of buying and selling. Maybe even you bring me a buyer, okay? Take your shares, okay? If you bring me a buyer, you can buy your shares. How do you advise? Because I think it's a very big problem, and I face it a lot, where individual investors, something happens to them, the families come to me, and I look at them and say, like, hey, what do you want me to do about this? Have you seen the agreement that you signed? No, I've not seen. But I know there's some money within this company. Okay, how do you advise? Because there's a lot of that happening right now. Because many people are moving into, they are speculative investors, right? And they're putting money here and there, here. And it's different from real estate, right? Because there's a title. Here it's a share. You don't even know what valuation your dad put a share at, right? Or you're going to put, and your daughter or your son is going to say, look, I think we put money in Edwin's company. Edwin's company is not a share. It's not a listed company, right? Now we want my money. And I'm sure, Edwin, you must have faced a lot of these problems where families are coming and camping in your office. The mzee has died. The mama has died. Can we cash out because we want to bury the person, right? I'm sure these are some part of the problems we deal with. How can you address that? But also, I'd like you to share your story in terms of entrepreneurship.
Wow.
As we move towards the last phase of the conversation.
I think with regards to families wanting to know what has happened to the investment of, I guess, if it's your husband who has invested, say, in your company and the like, it's about wealth management and asset management. And so an investor has to have structures within which that as wealth or asset will be passed down to his family or the like. So what I've found is a lot of, I guess, investors usually don't have those conversations with their family members during the course of their investor life. And then these conversations only happen when things have gone south or when that investor has then passed on. So I guess the advice would be, if I'm going to invest in this company in the form of owning shares, then I should then have some form of wealth management structure, which could be, do I have a trust, that then I transfer ownership to own this share during my lifetime, or am I going to have a will that then could create trust, so directly transfer the benefit of that asset to my family member? And most importantly, to have conversations with your family members or these important beneficiaries, whilst you can, explaining my investment is here, investment is here, this is how I've structured it. And there's no transparency. They are found 90% of the time. A lot of investors usually are quite private about their investors, particularly to their family for some reason. These have, not to say male gender, but I have found this to be very common. You'll find somebody has made significant investments, their wife doesn't know. They know from far, I hear my husband does this, or, the child knows, but they don't understand the nature of that investment, how it's owned. So I would say transparency. Transparency, because you're human and you're going to die, or things are going to happen to you at some point. So transparency with your potential beneficiaries as to your investments, the nature, and then owning those investments in structures that allow for wealth to pass from you to them efficiently.
Now let's talk about you.
Yeah.
That's a very, very important point. And I've just thought about something. When we sign, let's say you sign term sheets or you sign investment agreements, even with individuals. If I go, for instance, recently, when you go and sign, let's say, a money market fund, at the end of the form, they say, nominate your beneficiary. Is that correct? Down there, right?
Yeah.
But funny enough, when we sign investment documents and we give it to initial investors, we don't tell them, put down there your beneficiary. In case you died and you own shares in Seven Seas or Ponea, who should I be calling? I don't even know who to call, to be honest.
To add to
I don't
that,
even know who to call. So you've died. I'm not even sure, who do I call? Do I call your wife and say you had invested? Is that a beneficiary?
To add to that, most of the contracts you have, he assigns representatives, heirs. When you at the beginning of the contract, when you're indicating the party, there's usually a clause there that says heirs, assigns, and estate, and things like that. So usually at the point of contracting, there's already a structure in place through templates that sort of accommodates any additional future parties that could potentially come into this contract in different manners. So that is why I'm saying transparency is important, because if you're going to say my representatives, then you already know your representatives and you should be having conversations with them that I'm entering this contract. And by the way, if I pass on, these are the rights you have and these are the liabilities that you could potentially be inheriting as a result of this legal arrangement.
I got it. But now coming back to you as an entrepreneur, I can see I'll bring you back because you're still an entrepreneur. You're a lawyer on one side, you're doing lifestyle products and whatever else you're working on. For you, funding, are you, based on what you've seen, have you become cynical to funding, or have you decided you figure it out and you will raise money in certain instruments? What's your play based on what you've seen and the experiences?
My view, everything comes down to the personality and the person. It's the person and their values that then determine how they show up in business, that then determines the type of legal arrangements they enter into, that then determines who they do business with. So for me, yes, I'm a little bit cynical, but I'm also self-aware. I've made certain decisions within myself with regards to funding and capital based on my personality. So I'm a person who likes to sort of control my business. I like to be fully in charge of it. So equity capital would never be of interest to me. But I've also made peace with the fact that there's certain growth levels I might not achieve because I'm not willing to go in that direction. Likewise, I've done better with the banks because it's more suited to my personality. But then because banks also are not always reliable, then I've also made peace with the fact that there's certain levels of lending I'm not willing to take. So it's a matter of if I want to maintain control, if I want to avoid certain risks, then there are certain upsides that I'm not going to experience or benefit because of these decisions. So I think it comes down to self-awareness and what you're willing to tolerate now and what you're willing to tolerate in the future, what levels of impact you want to make, and what you're willing to be content with.
I think that's
you have to know your internal boundaries.
Yes,
What is it that you want?
Yeah.
And then what is it you're willing to sacrifice and let go of, and then work within that boundary.
Because so if you take your company to the stock market, then you have to be ready for scrutiny.
Exactly.
If you don't have, you're not ready for scrutiny and being in the public limelight, then why would you take your company to the stock market? Then I think that's a great self-awareness.
If you're going to pivot to certain levels, then you also have to understand there's an effect on your family life. So if say someone wants to be a mother and they want to do all these things, that balance you keep talking about, it's not always a balance with regards to the legal arrangement. It's a balance with regards to the things you're trying to achieve and the things you value in your life. So,
Christine, I really love if you could allow me to ask this, Mike, I really love the self-awareness, because a lot of entrepreneurs also don't, the same way they don't spend a lot of time on risk, they also don't spend a lot of time on self-awareness. I love that. Now, what I wonder now, given that it's a business and we are all mortal, in that setup, what happens to the law firm or the lifestyle beverage product if, God forbid, Christine gets hit by a truck?
It comes down to the legal structures. So you have to understand, as much as you have the self-awareness, you're also not in business for yourself. You're in business to make an impact. You have customers who you've made certain promises to, you're helping them. So you have to select a structure that can survive you. So what entrepreneurs need to understand is the various legal structures available, and how they can leverage those structures for their benefit. So in law firms, now we are allowed to have limited liability partnerships that have a separate identity to the partners who own them. So in case I died, then they would be remaining partners who then can continue the business. Yeah.
That's interesting. And really, I think one of the things, and I would like us to sort of contemplate what would be your big idea, and also what's your personal input to all this in terms of what's one thing that an entrepreneur out there or a founder out there would love to learn from, even for you out of this exercise, what you've taken away. From me, something has just resonated as we are talking. And last 2 weeks ago, there's somebody I'm trying to do some transaction with, and interesting human. And we sat in an evening and we really talked about many things. And they wanted to see how compatible we are to be able to do business together. And it has really helped me the last 4 weeks do a lot of major decisions in terms of isolating who is long-term and who is short-term in some of the engagements I want to do. And they referred me to something called the Tony Robbins concept of driving force. Tony Robbins' concept of driving force. What it does, it helps you align why you, another individual, or your business, another business, would be able to be compatible. It looks at 6 fundamentals. The first one it looks at is growth. Your growth, how do you look at growth, and how do I look at growth? The second one is certainty. How do you view certainty vis-a-vis how I view certainty? The next one is significance. How do you look at significance? Maybe I'm giving you money. For me, significance, I want to uplift I'm so passionate about technology, and I'm willing to give you capital. Even if I lose it, I've made significance, right? The next one is contribution. Am I making contribution by partnering with you, right? The next one is love and connection. You talked about the soul, right? The soul is somebody is willing to say, I'm going to support you because I'm so committed to ensure that I want to make sure you succeed. Even as you grow, the impact you're going to make as Edwin or as Bobby or Christine is going to have such a big multiplier effect to other people. I'm willing to put money behind you. That's social capital, whatever. And finally, what we call variety. Variety. I'm willing to get into this market. It's very underserved. I'm willing to put capital just to uplift. So if you think about those 6 fundamental items, if I'm raising money from you, or I'm taking money from you, and for me, my first variable in terms of ranking, then you rank those 6 elements. If my first number 1 is certainty, and mine is growth, and certainty is number last to me, because I believe certainty is God. Only God can make you certain. You leave the house, anything happens. Surely, I don't know. We say a pivoting, we thought this would happen, it does not happen. But there's an entrepreneur, there's a capital structure or banks, they want certainty. Yours is number mwisho. Your growth is number 1. Bank is certainty is number 1. Your PE fund certainty is number 1. Your growth is number 1. Your number 2 maybe is significance or contribution. Bank is saying I don't care about contribution for now. Me, I care about significance. Hence, I want to be seen a bank to you. Is that correct? This is already, you're very misaligned, right? The third one, maybe my third one could be love and connection. Maybe for me, I really care about the people I'm doing business with. I don't want to shatter the whole thing. But maybe for the bank, love and connection is musho. Maybe the PE fund you're investing with, love and connection is huko mwisho, right? So think about what happens. You're so misaligned, right, that even trying to put you guys together, because when you rank those things, right, you find you're so misaligned. So what I found when I spend time with people I want to do business with, and I told them to rank, and I do the ranking, you see where you're so different. Your growth is more altruistic. My contribution at my time of my life right now is very altruistic. It comes back to what you mentioned, Edwin, about building a product and service that is going to create value. Maybe you're building a product that's going to create significant impact in the society. Maybe the other guy says, me, I don't care about growth. Growth is me. Me, so long as I make money, I live in a good house. I don't care about what happens. Garbage can be there. So long as I put a picket fence, that is me. Me, I don't care about picket fences because those things come and go. Certainty, you have a nice house, today it's there. Today tomorrow it's not there. You have a good cut, today it's there, it's not there. I really don't care about it, which is why we're here. We're here because we think that if you think about growth, why are you here? Why did you guys step up? Okay, first getting entrepreneurs to this show in itself is a problem. You understand? Because I look at this as contribution to society, to the country, and growth for other people. But other people are going to say, when they come to the show, what about me? Well, people going to buy products from me because I'm on the show. I always have to convince them it's not about you, it's about us. So I think my conclusion, even as you get a partner, maybe could help many people look at this, is evaluate that Tony Robbins, what we call concept of driving force. Look at those 6 things, rank them, then figure out the partner you're going to be in business with if you see things in the same way. My first angel investor were very aligned in that same way. So that's why I was able, at a very young age, from 25 to around 30 something, I was able to work with them because we had very little conflict. Understand? There's very little conflict between us. Because even if things don't go right, we say, we are contributing, we are growing. Mike, don't worry, growth is also failing. Failing is also growth, right? Mm-hmm. But if a guy doesn't see growth, failing as growth, they see certainty, you made them fail, think about it. Immediately, there's going to be significant conflict. So my takeaway from this is, from that Tony Robbins ecosystem, using it to evaluate, first, even your life choices, your partners that you get in business with, could be financial, could also shareholding partners, could also be life partners. You could have life partner, you're thinking, as you said, when things fall apart, the life partner you thought was a life partner, for them, certainty was more important than growth. So all of a sudden, I say, my friend, hey, there's no cash flow. What certainty is this? You think I want to be in this kind of marriage? They're out, right? Because you're very misaligned in terms of your driving forces, right? So it's great, and I would like us to conclude with all of us. I think that's my takeaway from this. I just realized it also applies to the whole financial setup. Even the same thing with a bank, right? And I think it sort of accumulates and puts everything together in a good package. But maybe going to Bobby. Bobby, what would be your takeaway? What is it you'd like your daughter 20 years when she watches this show? Because in the next 5 years, it will become irrelevant to the internet. So we can as well use this moment now, right? And tell them our stories. Because maybe our stories wouldn't make any sense. Nobody will know PC World in the next 10 years. You still don't care about PC World, it's gone. But there are people who look at you and say, Mr. Bobby, PC World, what's your story? How do you like to close this?
So, to be honest with you, I think the lessons we learn along the journey they hold universal truth. It's just that it's very personalized to us, right? So when I look at it, if my kids are listening to this, or if I'm now talking to my younger self, these are the mistakes I don't want to repeat, right? These are the lessons that we are documenting here, which I'd want them to watch. But are they going to repeat these mistakes anyway? That's up to them. We gave them, and we did our rightful duty to give back to community and say, hey guys, we did this. There's no agenda here. This is the problems we faced, right? We are telling you, you draw inspiration from this and go make your decisions. But it is for me, my conscience has to say that I need to give this back. I don't want somebody to suffer what I went through. If I can avoid it, I will do everything in my power to share this information. I don't have to commercialize it. I don't have to monetize it. I just don't want somebody to go through what I do, because that point was so bad. It is not nice to see anyone like that. And God forbid that person would then be my own daughter, right? And I had not documented this because we are too busy and distracted. So really, my whole message is learn from others' mistakes. I like to take this quote that I've seen, I just read recently. Mahatma Gandhi said this: live like you're going to die tomorrow, but learn like you're going to live forever. Right? So let's give what we can. Let's teach what we can, and when we are doing this, when I'm saying these things and I'm reflecting back on my journey, the things that I should not be doing or should be doing more of, I'm learning twice, and I'm validating some of the things that I'm going to experience moving forward, right? Because moving forward, I'm going to be put in this situation again, but this time I'm wiser. And when I'm giving this message or this lesson, or I'm helping others, I'm helping myself too. I'm reminding myself too, hey, you said this on camera, don't go repeat it again, yeah? Contain yourself. This is a validation for you. Reminding yourself that these lessons were hard, don't forget them. We forget very quickly. Human beings, we just forget. And then we go repeat the same mistake and wonder what happened. So for me, I think my personal journey, my struggles have become my source of strength. I had to go through that. So I owe my past my present success. I could have only been, I'm now, what success looks like today and what success looked like to me when I was 25 years is a different question, right? But I'm able to be successful and lead a very happy, content life today because of those lessons I learned, right? Uh-huh. And if you can take those lessons from me, and maybe I'm relatable to you because I'm Kenyan, I'm third generation Kenyan, I'm here. I went through the lessons here in Kenya. I did not go there like Steve Jobs and try to relate to Steve Jobs and the other guys. I hear their story, I see it, but sometimes I cannot relate to it. But if you can listen to people from here and you can understand me, then here, these are the lessons. If you take some of those nuggets and apply, hopefully your life will be better. Right? And for me, then that's the satisfaction, that I owe it to you if I can help you. What good is this going to do? Where am I taking this? At the end of the day, I'm going to go back to ashes. As we said, we are all mortal. There's no fixed deposit safe for my knowledge that's accumulating interest somewhere, unless it's here now being documented, being passed on. Right? So for me, that's all I can say. That my journey, do I have regrets? I have so many. There's so many things I could do better. That's why I'm saying it to people right now. But you guys don't have those regrets as well, right? Learn. Don't make new mistakes, but move on. Learn from others, right? And this is going to shape my future, which I am now preparing for. I am very clear of the things that I want to do. I'm very clear of the things I don't want to do. A lot of people don't know what they don't want, so they keep exploring, and that's how things happen. And I did that for a long time. But now I'm very clear. If you ask me, what business will you do? I'll tell you straight away, I will do this business. I will never touch this. I'll never touch this. I'll never touch this. Straight away. I'm very clear about it. And that's now shaping my future, right? And that future is more about having a good quality life. The quantity part has passed. I've done it, been there, done that. It's the quality that I want to enjoy now, and giving back where I can. So really that's using my journey, hopefully, to help others.
Wow, very good.
I'm sure your daughters, many other people who know you and are going to take a lesson from this. You never stop learning. You just think, just when you think you realize you never stop learning.
Yeah.
Learning is a lifetime.
Just to quote, today I read something again based on learning. Henry Ford said that you are as old or as young as you are learning. So he says, I've seen many old 20-year-olds, and I've seen many young 70-year-olds. Because there's some 20-year-olds and 21-year-olds, when they leave university, they stop learning. So you are actually old. But you have these 70-year-olds who never stop learning. Those are the young guys. So your age is determined by your appetite for learning. And so for me, those are the kind of things I say. You don't stop learning. Like Mahatma Gandhi said, you learn till as though you are going to live forever. And that's where your growth happens.
I don't know, Edwin and Christine, any of you can go first. Whoever is ready to has layered their thoughts.
I feel like ladies first, unless she tells me to go first.
Because the conversation today was about capital. My last words would be, when you're getting an investment from an investor or from a financial institution, ultimately what's binding you is a legal relationship. So it is important to educate yourself about basic legalities, like the basics of a contract, the basics of legal structures. If your structure is a company, you need to understand shareholding. You need to understand board dynamics. You need to understand executive execution through executive management, because ultimately, even if we choose people we like, or so many things we can sort of predict, but there's also a lot of things that is out of our control. And when things go south, what we end up with is a legal arrangement. So my advice would be, know the legal basics, have a lawyer who can advise you about those legal basics so that ultimately it doesn't have to be like you've burnt the whole ground when things go south, which they will. You can at least have some decorum, in whatever situation that arises. Because even within family, even within friends, when my father died, ultimately what happens when we are looking for a burial permit is a legal one. Are you the daughter? What's the proof that you're a daughter? Are you succession? It doesn't matter that he has a will. It doesn't matter that he has trust. There's always we are bound. We are social, but we are bound by legal rules. So understand those legal rules so that you can leverage them according to the values within which you wish to do business or raise capital or relate with the different people involved.
Sometimes I think the older I get, I start realizing people next to me are lawyers, bankers, doctors, accountants. Is it by nature? Things happen based on what's happening to your life. Who sees you on a weekly basis? Either you're seeing a banker. Yeah, think about it. Those 4 people, Edwin, I don't know how many times you see them in your bank. And just let's assume you also see a politician. Also part of the 5 people you see. So this is amazing in terms of closing it. And I hope that sometimes I wonder, should law be a second degree?
It's important because everything is organized around a law, because human beings have demonstrated that we can't just trust each other. We can't just do things. So you need a law to step in to sort of be like some sort of neutral party, because the 2 individuals are not able to do that themselves. So it's a solution, a fortunate and sometimes an unfortunate one, but there's no other solution.
But it's funny, our first episode, which we've received quite good feedback and people have really been touched by it, is the issue of trust.
Yeah.
And we said 800-page contract. What does it mean really? if by the time you sign an 800-page contract, it means there was no trust in the first place anyways. So at the end of the day, some decisions that are going to be life-changing are going to be the ones we shook hands.
I would like to play devil's advocate.
But again, that is me being my usual
Optimist.
optimism, which I need to, I've been told I need to become self-aware. Is that correct?
Because
Self-aware.
everything in society is built around, because even if it's marriage, it's some form of contract. Whether it was going to the courts, the Western marriage, even African traditional marriage, is rooted in some form of contract. You take your people to my people, they agree. Everything is rooted in some version of contract. So we need to understand agreements in that manner.
I'm glad my elder daughter became a lawyer, and the younger one became an entrepreneur. Now the two can just make sure it works out, and they can listen to Christine now.
I remember last year, at the end of last year, I was saying, I want to do something different. I was thinking maybe I should just pursue a law degree. I was thinking about it seriously, because I realized even in law now, just because you have a lawyer doesn't mean you don't have to understand what is drafted in that contract, because ultimately it's a technical document. You've overcommitted. Sometimes when you talked about certainty, the investors want certainty. You want growth. So what do? You overcompensate by giving them numbers they want to hear. Is that correct? So they agreed of certainty, you growth. So that's why you guys meet. But it's a lie because you've overcommitted. They have overcommitted certainty. So now from day one, your marriage is already wrong. Is that correct? Because then they want certainty, you're telling them, don't worry. We'll chop. Is that correct? The other side, you're saying growth because you want growth. So you see, you're already in a lie, right? So maybe, as we said, maybe you should undercommit and overdeliver. Maybe sometimes don't take as high valuation as you'd expect. Because sometimes you push for that high valuation, that becomes a problem. Eventually it becomes a problem for you as you move along. So Edwin, as we wrap up, I'm really keen for us to see what's your closing position. Thanks, Christine, for that. That was also very profound.
Thanks, Mike. And first, thanks for bringing us together. It's been great hearing from Bobby and Christine. And I'm not even sure there's much I could say because I've learned quite a bit from them, this issue of contributing to society by telling your journey. I will walk out of here thinking about that, thinking about self-awareness. I think every entrepreneur is always thinking about doing, about changing, but less about me. How do I come across? Do I really believe? Am I overcommitting? So that thing of self-awareness is good. And as you go through life, it's really a series of contracts. I think if we were each to just think, and the contract does not necessarily have to be written. So if we really think about the contracts we've committed to, I think there are probably over 100 that you've committed to different people that you don't know. You only realize, there was a contract here when there are issues. So for me to be able to take all these kinds of stories and for you to step up and say, I'm going to tell them out is a really good volunteering to the world. For me, I just end where I started. I think making the world a better place, and I also like what Bobby said, not just the world, but also yourself a better place by looking for opportunities to bring ideas and capital together to create better products and services. If we can expand that space in this country, there'll be transformation in ways that we cannot imagine, because where Kenyans want to go are places where that space is big enough for people to say, this is my idea, give me capital, I will produce a product or a service. That scope in Kenya is very limited. I think initiatives like this will expand it. Hope you'll bring more people to tell their stories so that we expand that scope for people to get capital and ideas to make the world a better place. Thanks a lot.
First of all, I want to thank you guys for coming. And for me, I think we can't do this. We're just one side of the puzzle. The next side of the puzzle is the investor. The other part of the puzzle is the person who is holding your working capital. And the other puzzle is your financial institution that gives you a loan. I think those four pieces have to come together. And I think my conclusion is really speaking to the guys who are controlling capital. One, if you're a bank or if you're government who is today holding significant amount of working capital for entrepreneurs like ourselves, billions of shillings. The impact and the emotional toil you have on entrepreneurs in a market like this is so tremendous that the whole country emotion for an entrepreneur who left the house to set up a business, supply government as the biggest supplier or some of the big corporates, and then you don't pay 1 year, 2 years, 3 years. The interest rates with banks at the next level because they borrowed against your contract. The amount of emotional toil you have at a market at this level, with this amount of paying bills is too much. Just releasing that whole ecosystem, capital in that ecosystem, could change this country dramatically. That's number one. Number two, banks that you know clearly, you're lending to the same government that owes so much money to these enterprises. Maybe you have the leverage to be able to come back and say, come on, are we really making money fairly? Right? You're making supernormal profits on both sides of the equation. You're shafting the entrepreneur on this side. You're making money from governments. I'm not asking yourself really, are we really building the next entrepreneurs? Because if entrepreneurs don't grow in a country, we'll become purely an importing country, which is going to be a very sad situation. And finally, investors, okay, who then come and say, let me take advantage of businesses that are struggling. Because if the macroeconomics are wrong, there was a lot of cannibalistic investors that are popping up in this marketplace. So a lot of companies going down, you hear they were acquired by somebody you don't even know who acquired them. They're just taking advantage of opportunities or companies that went out there, started a business, but the factors that affect that business are not within the entrepreneur's control. But maybe the guys acquiring the business have those factors under control because they can pull the strings. I think as a country, the more we go deeper down this pathway, it'll be very self-destructing because we'll become permanently a net exporter of services, importer of services, which is going to be a sad situation. So we know there's a place for founders, there's a place for entrepreneurs, there's a place for financial institutions, there's a place for patient capital, there's a place for governments, there's a place for customers, there's a place for working capital, and there's a place that if we just sort of balance this out, I think we'll definitely have growth as a country. I think that's why we set up Foundersbattlefield, to really sort of speak to all these parties, because sometimes we have these conversations on tabletops, in bars, or in restaurants, but we never really create platforms where we can air this with a non-political bias, but also allow other entrepreneurs in future to understand and also to appreciate the risk that comes with being a founder, but at the same time, not stepping back and fearing to jump into the arena. Thanks a lot, and God bless you.